Hello and welcome. Good morning. You're watching India Market Open. It's midweek. The budget is behind us. I think we've all come back and with a little more. After having read the fine print, it'll be interesting to see how the street reacts today as we go into trade. But I think largely speaking, it's a thumbs up. At least the rating agencies seem quite pleased with us.
If I was a rating agency,
you'd upgrade us immediately, no?
Like, this is great at a point of time when all nations are piling on fiscal deficits. Here's a large country growing at a good pace, saying that they are beating the estimates and certainly on course for 4.5 for FY25. So that's great news. But I don't know. I mean, I don't find triggers enough for the market to go higher from where we are right now.
So if you're a rating agency, you can sit outside and say thumbs up. But if you are an investor, it's going. I think it's going to pinch for a bit.
Yeah, but I think sometimes no news is like we discussed this, right? You're not going to not invest or not trade because of an increase in taxation.
Having said that, no, I think I would look at it this way, and from the commentary that I've heard as well, is that this market was overheated, was looking for a reason. To cool down a bit, and this is reason enough.
You think?
I think this is reason enough for a bit, at least for a bit. You will see, and because look at the volumes also that have come in yesterday. It is DIs who came in at the end of it and sort of shored up the markets as well. So I think there's going to be a little bit of skepticism for some time, and maybe not the greatest of moods because of that LTCG. It's going to take some time to absorb. Of course, at the end of it, no one's going to stop doing what they start.
Yeah, and I think also for a foreign investor who's looking to buy into India, I'm not sure. One thing that stood out for me is a 2% increase in LTCs. They're not short-term traders usually, right? It's sticky money. Yeah. And if you've already gained on currency differential, and then you pay a marginal increase in taxation. I mean, that's what you pay to invest in a high return, high risk, high return kind of developing market, right? The alpha generation is going to come from these portfolios. So, and let's not forget that you can't find liquidity. The Nifty did react negatively when the speech was happening, but very soon after, we saw a flat close. So I think I'm taking heart from that this morning.
The one good part on the tax thing, because I differ on that, but the one good part is that in interviews later on, TV Somnathan mentioned that, okay, we are not thinking of any further tinkering, this is it. Which probably is a positive. There is certainty. Chalo, itna karna tha, ho gaya, it's done enough.
I don't know that this is it for now. He did not give a promise that never ever that, will you increase taxes. No one can do that.
No one can do that. But for now, in the current, in the current point, he said, as of now, in the current dispensation, we are not thinking of more tinkering or more increases, which is actually a good thing. You know now, maybe that for the next 3-4 years of the term, the presumption will be that this is it.
And in their defense, they are saying that how can you not tax the biggest asset class in this country, right? I mean, let's also keep all that in perspective. While as investors and individuals, this is a little disappointing news, you'd imagine. But in the bigger scheme of things, if you've got to get a Viksit Bharat, you need that money to come in from somewhere.
Absolutely. So yesterday when I was speaking to Vijay Kedia, while everyone was initially very negative, he came out and said in his usual style that Tamanna ji, aapko 80 crore logo ko to ration dena hai. You have to make roads, you have to make expressways. So yes, all in all, I think markets will survive a small increase or a fair bit of increase in taxes. But let's see what the global cues are looking like today. And if you're looking for a positive sentiment from global cues, that's not really coming in as of now, because US markets did see some selling as investors are worrying about high valuations. I wouldn't say a panic selling, because pull up what you saw yesterday, and the US markets were mildly down, I would say. A 57-point cut on the Dow is no biggies. Nasdaq also about 68 points down. It's what happened after markets closed there which could see further worries, because you had big tech results come in and they weren't so exciting. Alphabet was the big one, and while most of their parameters were in line, YouTube revenues were not in line. So they kind of missed estimates. You would see a negative move there in the futures side of things, and that is one pull down. Even Tesla, their auto revenues have dropped 7% year on year, and Tesla has been largely having a bad time, and that kind of continues. So even over there, the quarterly results are in focus, as they will probably come back in focus here as well. Let's look at bonds. Remember, it's going to be the next 48 hours or so is important, and the next week is important. So you have Q2 GDP, you have inflation numbers coming in between Thursday and Friday, and next week you have a Fed meet. So no great expectations at all of Fed doing anything with rates next week, but commentary will be key. Ahead of that, the 10-year at 4.25. Crude's doing okay. So between inventory concerns and ceasefire hopes, it's in the balance. So steady, range bound, I would say. Brent is about at $81 levels. Not bad news for us at all. Asia's opened a bit weak following US cues, and there it continues to be. So if you look at the implied open for India as well, you will see a red downtick there, or 60 points odd down that we would open, but not a deep correction. So will we see balancing factors here is the big question, and some of that balance could be seen in how the fund flows panned out yesterday. Remember, we were keen to see who bought and who sold. So FIIs, after consistently buying, and remember, even in the run-up to the budget, they were net buyers. They ended up selling about 2,975 crores. DIIs shored up, not massively, but about 1,419 crore rupees buying on the DII side. So budget may be behind us for now for some time till we understand, impact, and of course some budget impact will continue. I think focus will shift to results to some extent.
Yeah, and I don't know. I mean, the results piece or otherwise doesn't seem to be necessarily the most buoyant, if you will. Let's see if it changes.
Don't have to be so careful. It's not the greatest.
It's not the greatest of earnings season, yeah. Well, but yesterday there was a small event at one of the brokerage houses, and their internal estimates are that as per their earnings estimates, we are trading at about 20 times FY25, 21 times FY25. So not scarily stretched. So that's the key point. But it's difficult to find triggers for further upsides, but for the liquidity cushion. There are two things out here, both on the election verdict period and yesterday. Independent of what people's opinion may have been, Mr. Market is saying that I am not ready to correct too much, and I'm being bought at all dips. And that is what we saw yesterday as well. No particular reasons. FI numbers was selling. The derivative markets didn't see tremendous amount of short covering, if you will. It's just some bit of buying happening in key sectors, market management, what have you. Yesterday it was ITC and FMCG which pulled the markets higher. So Mr. Market is saying that you're not ready to correct per se, and there's a liquidity cushion out there, and therefore focus on sectors. Most brokerage notes are saying that industrials is probably a pocket that you want to be careful on. I don't know why people were anticipating this very high push up or leg up on capex. Even Manish Dangi yesterday was saying that it should have come. But I think the economy can absorb only as much. But brokerages are negative or partly negative on some of the industrials because of the valuations and no increased capex. So that is one pocket. And now the markets have enough reasons to be constructive on staples and defensives. I mean, if sector rotation was not the only reason, enough other reasons given by the budget to be constructive on this bucket. So that is something that you want to watch out for. Yes, the stocks have rallied a bit already, but maybe there is more in store. So do watch out for that bucket individually.
Yeah, and I think we saw that yesterday, right? A whole bunch of these consumption staples went up in trade. Even though earnings so far haven't given us enough reason for brokerages to turn constructive on consumption names. But the fact remains that the defensive play, like Niraj said, and maybe some parts of the budget have actually or potentially could help these counters. ITC is in front of you. No news is good news for that company. Syntax was increased, and that was viewed as a massive positive on ITC yesterday. But in terms of today's trade, no dramatic move expected. Remember, the budget in most sense didn't give much for bulls to hang on to or bears to take away in that sense. And the Nifty as well technically has done quite a good recovery in intraday trade yesterday. Bank Nifty, though, looks a little weak at this stage. Important technical levels were taken out, and we've seen a fall on that index. So while Bank Nifty looks nervous, the index itself may be holding up in today's day of trade. Well, implied Nifty is indicating to a flat to slightly lower start, but no big cuts anticipated just yet from the way we look at it. Well, let's quickly move on to earnings, because that is the big, still remains the big talking point in the midst of the earnings season. We'll start with consumption major HUL. Largely, brokerages don't seem enthused by what they've seen on HUL. We went in with low expectations. Numbers have met those low expectations. Management commentary as well is not sounding very promising about a strong recovery that's currently underway. But just to highlight for you the numbers, revenue was up marginally 1.4%. EBITDA was up 2.2%. Margins have also remained flat, and net profit has remained flat. So it's been a flat quarter for HUL, and like we said, there are no major strong signals indicating a recovery in demand just yet. The stock went home flat with a slight positive bias. It was probably defensive budget play, but earning expectations was muted, because of which you didn't see a big rally on the counter yesterday. Bajaj Finance was the other one that reported after markets closed. The numbers look actually pretty good, right, when you look at it on the screen, but it met street expectations. So they've not outperformed what the brokerages were expecting on Bajaj Finance. The net profit rose 14% to 3,912 crores. Their NIs grew 25%. Remember, Bajaj Finance has resumed sanction and dispersal of loan under Ecom and Insta EMI card, and issuance of EMI cards after the RBI has removed restrictions on the business starting the 2nd of May. In its first quarter update, Bajaj had said that its new loans had grown by 10% during the quarter to 1.1 crore bookings. AUM has also expanded 31%. The 2 and 3 wheeler finance portfolio has grown 34%. So while those numbers look strong, remember we went in with expectations that were already elevated on Bajaj Finance. So it's at best a meet of large brokerages. Well, the other one that was a good set was Torrent Pharma. Profit has grown significantly, 20% higher. Revenue increases by 10.3% to 2,859 crores. EBITDA rose 14.3 to 904, and margins have also expanded about 110 bips, coming close to 31.6%. So all in all, those are the three top ones I have. HUL muted, Bajaj Finance good, but brokerages met street expectation. But Torrent, I think, was a standout.
Yeah,
good numbers there.
Yeah, in line. The thing about Bajaj Finance that maybe stood out, and by reading all the notes, is that the credit cost uptick was just a bit sharp at the higher end. And Morgan Stanley cited that and said that the second half will see an inflection, but the first half might be muted. Jefferies has not been too kind. Jefferies is saying that this is too bad. They've cut the target price from 9,200 odd to 7,700 odd. Yeah. And they are saying that the stock may underperform. So this credit cost piece for Bajaj Finance, let's see if it hurts the stock today.
And also the fact remains that I think the expectations are running high with this Ecom and this RBI restriction lifting. Of course, maybe the impact is not going to be upfronted. There would be a work in progress. But for now, I remember on 2nd of May when those restrictions got lifted and we saw those business updates come in. And most of us were quite impressed. But it seems like it could have been factored into the price.
Yeah, so Bajaj Finance might see a bit of pain today just because of the higher expectations and the run-up that you've already seen. So that is one to watch out for. Some others which came in yesterday, and of course we'll get to the budget piece in more detail in a bit, but these are results, etc. ICICI Prudential Life is one we should talk about. New business value, so your VNB has gone up 7.8% to 472 crores. Margins have contracted quite sharply though. So this value of new business margins have gone from 30% to 24%. So this squeeze in margins is something that might be seen as a negative by the street, and brokerages are also seeming to echo this. APE is up 34.4%. That's fine. PAT is also up about 8.7%, and assets under management are fine. But this growth is coming in actually stronger than expected, but driven by ULIPs. Again, ULIPs is something regulator does not like. Insurance schemes, mixed with equity or mutual fund type investment, the regulator doesn't like it. That's a bit of a problem. And they're also lower margin products. So you might see some pressure coming in there. So ICICI Pru could have a rough day. It was relatively fine yesterday in all of the storm of the post-budget situation. ICICI Securities, on the other hand, has had a good set of numbers. So total income is up 76%. Net profits are up 94.5%. A robust kind of a quarter for this company. What's led to total income growth? Growth in the broking income and investment banking segment has been good. Retail broking and allied revenue has grown 92% year on year. And, I'm interested in seeing what happens to this category of companies today. All your investment-linked companies, your AUMs, your brokerages, all of the listed players in this space, because the idea was that maybe this LTCG increase will hurt them. But beyond a point, not really, because are people going to stop doing what they're doing? Even if the theory is that this has now become something which is harmful, addictive. I mean, on a different note, guys, you don't tax cigarettes, but you tax investment in the markets. Not completely related, but also gives you a sense of how the government is looking at this.
Gambling is as bad.
I was about to say this.
And India is the only
Gambling.
country where gambling is also illegal. So what do you do, right?
Yeah.
You trade the market as if you're playing a game of blackjack.
But you shouldn't do that. You shouldn't do that. But I don't know if increased taxes is going to do anything to it. I mean, did people stop gaming?
No, I can't
Did people
imagine
stop
why it
gaming?
would, because
I don't know.
honestly, if people are doing this as a profession, or a business, it is business income at the end of the day, right? You pay for what you make, or you pay when you make.
Okay, so no, taxing because you're making money and you should pay for it is fine. But if you're taxing to stop people from doing something or dissuade them, then that's a little different. Because I mean, people are not kids. It shouldn't be a nanny state where people will burn their fingers and they'll learn. Anyway, but one more stock that I want to talk about is AstraZeneca. Now, AstraZeneca ran up yesterday, but I thought it deserves a little bit more detailing because it could see a continued push. The reason why AstraZeneca was up 13% is because basic custom duty on specific cancer drugs was reduced yesterday. 3 cancer drugs specifically, those names on your screen, I'm not going to try and pronounce them, but the duty has gone from 10% to nil. Now, for AstraZeneca, a bulk of their revenues are in oncology. They market these specific drugs in India and they get this through their parent. So for AstraZeneca, this is a win-win. They're also one of the top 5 leading companies in oncology business, and 43% of their growth in FY24 actually came from this segment. It contributes 62% to their revenue. So there's a very solid reason why AstraZeneca ran up 13%, those 3 drugs. And just on a broader note, everyone we spoke to yesterday from this sector, Sunita Reddy, Kiran Mazumdar-Shaw, said, great, you've reduced this on the 3 drugs, but if you really want to make a difference for those suffering from cancer, it's epidemic proportions in this country, the way it's growing, you have to remove GST on all cancer drugs and on diagnostics. So that hopefully we can hope for in a policy way, but in terms of a stock, AstraZeneca definitely could have more to go.
Yeah, well, let's see whether AstraZeneca has more to go, if ITC has more to go. And I'll just take a minute because we've got Mark Matthews ready. But very quickly, just one stock actually, and that is ITC. Do watch out for that one. It was a big move in trade yesterday. Jefferies has upgraded the stock to a buy, the target price of 585. And they're saying that no news is great news. It's a clear winner with the government leaving tobacco taxes unchanged and multiple other reasons. But yep, watch out for staples for sure. But good time to maybe go across to a very special guest, Mark Matthews, Head of Research Asia, Julius Baer. He joins us right now. Give us his sense of what he made of the budget. Mark, great having you as always. Thanks for taking the time out. What's your first take? Is the fisc discipline a bigger winner, or is the raising of capital gains tax a bigger drag, if at all?
I think the raising of the tax is a bigger drag because most emerging markets do not tax non-residents on capital gains. I guess the only positive I could say is that the long-term capital gains tax rate, which has gone up to 12.5%, 12.5% is still a very low number compared to the capital gains tax in most developed countries. In Canada, where I'm from, it just went up to 67%. So 12.5 sounds pretty good compared to that. But net, I would say, the taxes are not good for markets, and especially capital gains taxes. So it's a populist budget. To your point, they decided not to increase taxes on tobacco, but they are increasing taxes on capital gains.
Mark, just wondering, how is that a really big deterrent? I mean, one of the thought processes that is coming in is that India wants to align capital gains taxes across asset classes. And it's very difficult to bring the taxes on some of the other asset classes lower. So giving a directional move that this is what it is, and they have said that this is about it. For the near term, at least, there doesn't seem to be any more tinkering. Are you, or do you think global investors will take it very negatively? or does the growth that India will provide make up for some of that disappointment?
The growth makes up for the disappointment because, with a few exceptions, most emerging markets are problematic now. China, obviously, first and foremost. And so then you get to very illiquid places. Like, for example, I'll just tell you, Malaysia has a very good story right now because of cheap electricity, English-speaking, low-cost labor. And so there's billions of dollars going into data centers there. And they have quite a pro-business government and king that have taken over recently. But, I mean, who's going to invest in Malaysia? It's a tiny little market. So on the pecking order of emerging markets, you really obviously have China at the top because of its size. And then after is India. So India, with its superior growth, I think, and the absence of good stories in other large emerging markets, people don't like the capital gains tax in India, but the fact that it does have a superior story to other emerging markets, yes, does make up for that.
Mark, hi, good morning. Just trying to get a sense on whether you think that this initial pinch on the capital gains tax is going to sustain for a bit, in your view on India's performance as an emerging market short term. How do you see this pair out? And are you looking at it also in the context of a market that's really run up and needed some reason to cool down? Do you see that cool off coming now?
I completely agree that it needs to cool off. Unfortunately, I don't think it will, especially looking at the reaction in the market after the budget. 25 times trailing earnings relative to an historic average of 20 is the best you could say is fully valued, given that the macro environment is probably better than the long-term average right now. But I don't think it deserves to trade at more than 25 times. And the earnings growth this year, we're predicting about 13%, down from 17% last year. So I would have preferred that it just build a base sideways here and catch up to let the earnings, sort of bring that price earnings ratio down to a better level. Because it's never good when anything is overvalued, be it a stock or a property or whatever it is. That being said, I think it will continue to grind higher because the domestic liquidity is so ample.
Just one more, Mark. I just want to understand if there is a rejig in what areas look exciting for you within the Indian markets after the budget. The push on employment, the boost or the attempts to boost consumption in the staples area. Is that leading to an overall sort of review of what you think is working within the Indian equity space?
No, I have read research to that extent. I've seen people moving away from industrials to consumption. We're not doing that. The CapEx story, in my opinion, is unchanged. It didn't change from the interim budget, and it's clear the BJP, after the election, is maintaining its bias toward the development of infrastructure in the country. So that hasn't changed, and the consumer staples are expensive. And I would just say that the importance of the budget for the economy and by extrapolation the market has been declining over the last few years as more and more important decisions are made outside of the budget. So we have not made any changes to our investments post-budget.
Right. Mark, how much % of your portfolio is exposed to India currently?
Top of my head, I struggle. I don't want to give you a number that I don't know. So we have exposure. It's in the grand scheme of things, I must confess, not that material. Our bias has always been, well, not always, but at least let me say the last 15 years, our bias has been toward growth, which means technology in the United States. But I will say that we like India, and if there is a pullback in India, that we will view as an opportunity.
Mark, what, in your opinion, is the quantum of pullback you would want to see to turn overweight India? And if you're buying tech in the US, does that mean you're overweight tech in India as well? So, two parts to that question, right? Yeah, what sort of yeah.
We are overweight India in the context of Asia. It's our favorite Asian market. It's our favorite emerging market. We are confident India will outperform its peers. I think it could possibly even outperform the US over the next 5 years. But the US has still this very strong story that it is the, technology is the largest sector in their stock market. To my knowledge, there's no other stock market in the world that has that distinction. Most of stock markets in the world, the largest sectors are banks or industrials or consumer. And the US does technology better than anybody else. And with artificial intelligence, it's only going to become bigger. So we don't want to deviate from that. But I do think that the Indian story is a very good one. And I think I'll leave it at that.
I'm going to go back and ask you, what is the quantum of a correction that would make you comfortable to buy more into India?
10%.
Oh, lovely. So, okay, just another quick one. Does India paper look far more attractive at this juncture than Indian equity?
No, I think India is a growth market, and when you're biased toward growth, you want to be in equities. I do think that the narrowing of the fiscal deficit will result in a credit rating upgrade, maybe more than one. That'll be good for Indian bonds. But there's so much good yield all around the world, including in investment-grade developed markets, where you can get upwards of 6.5% in dollars with a historic default rate of 0. I don't really see the need to go out of our way to own Indian bonds, but Indian stocks, I do see that need.
Mark, I have one last question from my end. What within India? I mean, are you changing your preference towards maybe the defensive staples? I did hear you say that you are still focusing on industrials, but that is a very wide bucket too. Is staples making some bit of a comeback, or is your portfolio positioning unchanged pre and post budget?
It's unchanged, and I think the staples are too expensive.
Okay.
So, yeah.
One more quick question. With everything that's happening outside in terms of an anticipation of a rate cut, we've talked about how the recent rally for markets like Japan, India, most parts of the US has been liquidity driven. If we do get a rate cut in September as expected by the street, is that going to give Indian markets, emerging markets, another leg up from here, you think?
No, I think the rate cuts are in the price. I don't recall what Fed fund futures are pricing for September, but if memory serves me right, it's around 80 or 90%. So when it hits the tape, I don't think anybody will be surprised at that. People are probably a little more up in the air about what's going to happen in November and December. And for the record, we are looking for additional rate cuts in November and December. So if those ones happen, maybe that could provide more upside to markets. But the September one is in the price.
The big sort of movers you're looking at from a global markets and an Indian markets perspective next, of course, September becomes important. You said November and December as well. US elections there. And what would be the next big mover from the Indian markets perspective? Because our big events are pretty much done. Election done, budget done.
No, I agree. So we have the earnings to look forward to, and it'll be very important to monitor the margins of companies, because the big reason for the earnings expansion last year was margin expansion. And so I just don't think they can do that twice, 2 years in a row. So I'll be watching the earnings more closely than anything else.
Mark, India versus China, how are you allocating to China right now? Betting on a recovery there or still keeping away?
Well, they couldn't be more diametrically opposed. India is doing very well economically. The stock market is on fire. and China's not doing well economically, and the stock market is absolute dog. So a contrarian, of course, looks at China with great interest, and it hasn't really paid to be contrarian anywhere over the last few years. Markets have been very momentum driven, but China has a lot of pent-up fiscal spending power that they could activate in the second half of this year. And I find, trying to guess Chinese policy extremely difficult. It's opaque there. But they have the resources, if they want to stimulate the economy based on the budget that was decided earlier this year. And I noticed that the June home prices in Beijing and Shanghai, the two largest cities, turned positive for the first time in 9 months. So I don't know if that can continue, but there are some potential positive things. And then beyond that, if Donald Trump's elected, I believe there's an opportunity for a reset in U.S.-China relations, which would be very important as well. I noticed China's already trying to warm up to some countries it had very frosty relations with: Japan, the Philippines, and Canada. They've all met there, and the foreign ministers have met and said we want to improve our ties. So there's so many things that have gone against China the last few years: geopolitics, bad economy, property sector disaster. Those things, there's a possibility they could turn around, and then it is, if not the cheapest market in the world, then certainly one of them. So it's fickle, but I would say China's actually looking very interesting on a 12-month view.
All right. So China on a 12-month view. Right now, India versus China. India comes out on tops. It's. I think the long-term capital gains tax negative for now, but perhaps will be absorbed by the Indian markets as well. Thank you so much, Mark Matthews, for speaking with us this morning. That's a great view. We're going to take a very short break, but before we get into that break, so many views coming in on what these taxes mean. And I'm just going to put out for you what Nitin Kamath of Zerodha has said. And he's actually broken it down from, of course, the perspective of a large house like Zerodha, saying that for us, essentially, their STD that they collected from October 1st was 1,500 crores last year. And if the volumes don't drop, that's important. If the volumes don't drop, this will increase to about 2,500 crores at the new rate. Long-term capital gains tax, of course, has been increased. So has short-term capital gains tax, both applicable from today. I think the last line is important, where he says if the idea was to cool down the activity in the markets, this might just do the trick. What do you think? Do you think this will cool down activity in the markets? Let us know on all our live feeds. On all our social media platforms. Meanwhile, we will take a very short break. We're coming back with the F&O setup and more.
Welcome back. You're watching India Market Open. It's going to be an interesting day of trade. Implied Nifty is indicating to flat to slightly lower start. But let's not forget, we did cut off or trim off most of our intraday losses in trade yesterday to go home with a marginal cut of 0.1%. It looks like a start sub levels of 24,400, but it'll be interesting to see where the markets take us. 24,700, remember, is a key hurdle for the street, followed by 24,855, and on the downside, 24,200 still remains an important level of support. It was Bank Nifty that has gone into a little bit of a worrisome zone because of its big fall on the trending falling channel. So that remains a bit of a sore point for the markets. But apart from that, sectors like FMCG could be lending some support to the Nifty on the upside. Well, let's go across to Avni Bhatt, Senior Vice President, Derivative Research Analyst of JM Financial, joining in. Hi, Avni. Good morning. Thank you very much for joining us today. Avni, the markets considerably cut down intraday losses following the budget speech yesterday, and we went home with a cut of about 0.1%. I believe on the upside, 24,700 remains important in terms of a hurdle, and on the support side, 24,200. Before I go into your specific stocks, what is the trading strategy, if you have one, or the view on the Nifty?
Yeah, good morning, everyone. So, yes, a good recovery from the lows, but a close below 24,500 on Nifty and below 52,000 on Bank Nifty is a sentiment dampener. And on the upside, as long as there are slight changes in the levels for Nifty and Bank Nifty after yesterday's OI developments on the options front. So now, as long as Nifty does not, reclaim 24,600 level, I think it will be a slow grind towards 24,250 on the downside, and also probably 24,050 levels. While on Bank Nifty, it is the 51,500 mark. If it breaks today during intraday, then we may see Bank Nifty go all the way down to around 51,130. So it's a day when it's going to be a sell on rise market. For Nifty, around 24,550, one can take a short trade with a small stop loss of 24,600 for a target of 24,250 on the downside. And for Bank Nifty, one can initiate a short trade at around 52,000 levels. These are all basis spot levels, and with a stop loss of around 52,350 on the upside for a target of 51,130 on the downside. So as of now, it's a sell on rise market. The data is quite negative when it comes to options OI built up, and also futures. There is no major change in the open interest, but that's also because we have the rollovers kicking in, and expiry due today for Bank Nifty and for Nifty tomorrow. So overall, the sentiment is negative as long as 24,600 is not reclaimed and 52,500 is not reclaimed on Bank Nifty. Till then, it remains to be a sell on rise market.
It's a sell on rise market. That's pretty much been the consensus view on the index the last couple of weeks now. Avni, let's talk stock specific trades. Bullish on Aurobindo Pharma?
Absolutely. Aurobindo Pharma, so stock specific action has been really good, and it's got it's got a lot of divergence as compared to the index moves. So when we are looking at a slightly negative picture on the index, I think we should go with the defensives. And Auro Pharma is one pick where we've seen a massive OI addition of around 30% yesterday. And along with a positive price action, which indicates that it's a long build up in futures. Trading volume and delivery volumes have shot up. Delivery volumes have gone up by almost 100%. And technically, consolidation and a base formation is seen in last 5 trading sessions, wherein Auro Pharma has taken support around the 20-day exponential moving average of 1305 on the daily charts. So now the stock looks ripe to test its recent all-time high of around 1410. So to play out the strategy, the best way to play out the strategy is go for a vanilla option buy of August 1400 call. It closed at around 35 yesterday. Target would be 55 and stop loss will be 23 on the stock.
Right. Avni, I believe you're also constructive on HCL Tech. You're buying August calls on HCL Tech. You want to walk us through the strategy there, what the TP is and the stop loss is?
Yes, absolutely. So basically, there are three sectors that have been doing good in spite of the indices falling. One is the pharma sector, second is the IT sector, and FMCG, of course, has moved up quite a bit. So we are not touching the FMCG space because they've moved already quite a bit. So from the IT space, I would go with HCL Tech. HCL Tech higher high, higher low formation has been seen on the weekly charts. And short-term moving averages on the daily charts are also below the price action and will continue to support the uptrend. So in the future segment, around 20% OI addition has been seen for the August series, and again on a positive price action. So that's a long build-up. So it's likely to test 1630 to 1635 levels within, I think, 1 or 2 days. So quite positive on HCL Tech. We can go with buying of 1600 call for the August series. It closed at around 50 rupees yesterday. The target would be 72 and stop loss can be kept at 35.
Right. Thank you, Avni. Those are two constructive calls on HCL Tech, Aurobindo Pharma. Avni recommends buying calls for the August series on HCL Tech and Aurobindo Pharma, while she's circumspect on the Nifty and Bank Nifty and recommends a sell on rise strategy. But let's talk about what this increase in STT is going to mean for derivatives. How do traders thrive in this environment? And you want to walk us through this, Sajid, the implications of this, when this has become reality, and the impact of it?
So the STT increase which has happened for sale of options and futures is effective from October 1 this year, and it's a nearly 60% increase in number. So the number is alarming in that sense. But if you look at the implication for trading, it's not going to be much of an action which is there, because, and that government also realizes, because yesterday in the interview of the Finance Secretary and the Revenue Secretary both alluded to this, saying that we have increased it, but it's not to the extent that is required, and the rest of the action will come from the regulatory point of view, and that's what the regulator have to do. Look at the impact. We were looking at the NSE data, and the average trade size for options is 6,000 rupees there. So the impact of STT is only around 2.3 rupees or something.
Yeah, in the bigger scheme of things.
In the bigger scheme of things, right? So if an investor is just putting 1 lot or 2 lots, whatever it is, he's paying 2 rupees extra for this STT which is there, and he's willing to absorb that kind of thing. So it's not going to impact the revenues, the trading volumes as such for the retail investors, which the government is trying to, prevent them from coming.
So then what's the point? Because that's the purpose, right? And we just, before you came in, we talked about what Nitin Kamath has tweeted out this morning.
Nitin Kamath spoke about the STT revenue increasing from 1,500 to 2,500.
If volumes remain the same.
Yes.
If volumes
the
remain
answer
the same.
is volumes are going to remain the same unless the regulatory action kicks in now. Now, the regulatory action will take at least 3 months, because there is a consultation process which is underway. The Secondary Market Advisory Committee has already submitted the consultation paper to the SEBI. SEBI will make this consultation paper for public feedback out in the next week or two, and then there is going to be the tightening that's going to happen, and my estimate is that it will coincide with the STT coming into force from October 1. There are 3 things that's going to happen. One is that the lot size are going to be consolidated, so which means that our average ticket size today is 6,000 rupees. If it goes by 5x, that will become 30,000 rupees, and then as a result of 30,000 rupees, you have to pay a higher margin on that will come in.
Sajid, you keep saying this is what is going to happen.
Yes.
You mean this is what could happen?
Presumably going to happen.
There is a consensus among all stakeholders, among the expert committee, among the Secondary Market Advisory Committee, and there's a dictate which has come from the regulators at the overall level, which is the FSDC level, where all regulators agree that there is a speculative trading derivatives.
Central
and that
government has to sign off, no?
Central governments have already signed off. That's why it's happening, right?
And I think, Sajid...
See, the SEBI's mandate in the last 6 months has changed on derivatives. 6 months back, the chairperson was talking about that the system is there. We are not a nanny state, and we are not going to control it. Today, they are saying that we need to control it because it's now impacting macro. It's not no longer a micro issue, it's a macro issue. Your household savings are moving towards derivatives. The share of liquidity for banking is coming down. That's RBI's perspective, saying that RBI's banking and liquidity is getting impacted because liquidity is moving towards derivatives. So all those things are coming into place, and it's going to happen. So that's why I'm saying that it's going to happen, even though we may not, traders may not like it, but this is something which is in the horizon.
Yeah, and just very quickly, in fact, talking about what SEBI had done, I think it was a few quarters ago, that issued a report which said 89% of all short-term traders were losing money. Of the remaining 11% who did make a profit, they were under rupees 2,000 rupees per trader per annum on an average. So while that increase may seem very little to a layman, for an intraday trader, it's all the difference between a profitable and a loss-making trade. And the reason you've seen an 89% traders losing money is because execution costs are also very large. So I think that is something else you want to keep in mind. But there are ways around it. I can tell you 3 strategies which could work.
You can say it
with
after
higher
my
STT.
answer. The thing is that the issue here is going to be very simple. It's not only regulatory actions which are going to come into play in there. There are inherent cost advantages or cost arbitrages which are there, which will increase the cost for you going forward. Like the true to label kind of is one of them, which will impact all the brokerages. As a result of the raise, they will raise the transaction cost. So the discount brokers will not be a discount brokers anymore.
Sajid, I read a line somewhere that said that traders have said that we know for sure that our bills are not going to come down. So what we now need to do is increase our revenue. Now, if that is the mindset these traders are going to go in with, this could potentially turn into a double-edged sword. But for now, we will hope that this is a step in the right direction. We're curbing, speculative trading. But a couple of strategies, and I think we should talk about that eventually, is that, you can look at stocks that are more liquid, so the spread is easy, the bid-offer spread is less, so you can look at stocks that have better sort of RSC, which is relative strength as compared to peers. So lots of ways that traders will find around to make money despite an increase in STT.
Okay, well, we will watch out for all of these as well, and at some point of time later in the show, Samina will highlight these strategies as well. Somebody uses these strategies very effectively is our next guest.
Yes, actually that should be our question to him.
Why don't you go to him?
CK, hi, good morning, thanks for joining in. CK, we were just debating about how, while the increase in STT to a layman may not sound significant, but it makes all the difference for an intraday trader between a profitable trade and a loss-making trade. A couple of strategies that I believe that intraday traders could actually use in order to increase profitability is trade liquid F&O stocks, use high ATR stocks, which are average true range stocks. Again, stocks that have a higher chance or probability of making money. Do you agree? Do you feel like traders will find a way around this? And in your opinion, what are those intraday strategies that traders can probably take up? And please, by no ways am I encouraging traders to do this. We're just getting a sense of what else can be done if you're looking to do something.
Good morning, everybody. Yes, budget has come and gone, and the most feared item has come through, which is increase in trading costs through short-term capital gains, long-term capital gains, change in STT, etc. So the question you asked is very relevant. Will traders now withdraw or reduce their trades because the costs attendant to have increased? My opinion there is firmly no. Because when people are trading, they are looking at the price action and their entry and exit points. They are not really thinking about taxes at the time of initiation and closing of trades. That comes at the end of a quarter or at the end of the year or something. When they look at, they say, oh my God, I had actually made 5 lakhs, but then 4 lakhs have gone away in trading costs. But that's kind of realization there. Right now they feel okay. And as you rightly put it, I need to increase my margin of profitability. So I think that will be a change which will come in, where people now, the advisory side, the broking side, and the traders themselves will start focusing, and as you rightly put it, on greater ATR stocks. Now, ATR is not a much thought about indicator, but I think after this, some people, some traders, savvier ones at that, will probably look at the ATR as a vital indicator which tells you that for the same buck that you spend, which will be the one which will give me a better return. So I think that's a good thing in a roundabout way. But then are traders going to stop trading, or is the volume going to be greatly affected? My firm belief is no, because it's like those statutory warning on cigarette packs. They've been there for decades and nobody has stopped smoking. And so it's a kind of that. Trading is another addiction, and people will engage in it no matter what. So whether it is increase of LTCG from 10 to 12.5, now people are saying, okay, 2.5%, no big deal. Now 15 to 20 may, kind of pinch, but then the government's view is very clear. If you make money, share some of it with us. And I don't see too many arguments that can be made against that. Now people are talking about it as though, their entire careers have been destroyed and all that. That's all humbug. So you make money, find ways to make more money. Now, whether you want to deploy an ATR on it or be more selective on your trade selection or employ better strategies, that is the only thing, and that's all completely your responsibility. It's not the government's responsibility. They are just saying, if you make money, share some of it with us. I think that is pretty fair too.
Right. CK, completely agree. And you know what I'd love to do is maybe after the show, connect with you at a later stage and get those ideas and strategies for traders. But for now, for viewers that are tuning in and who follow you religiously, tell us what your top stock recommendations are.
Well, I think the best answer comes from the market itself. Yesterday, the recovery was led by FMCG stocks. And within that space, I think there are many that one could still look at if one is trading the shorter end of the horizon. And I think stocks like, particularly the MNC types, stocks like Colgate and Britannia and Titan and all of these are the ones which are already up and running. And I think they should continue to run. Now, Hindustan Lever came out with numbers. I think with the numbers being palatable and the fact that there is a rural tadka which has been given in the budget also, I think Hindustan Lever should be sought after. ITC had a phenomenal rally yesterday itself. So maybe after a period of rest that could go. I think some element of shorting usually happens in ITC at every budget, because that's a favorite whipping boy. So every budget you have two favorite trades. One is short ITC and the second is long fertilizers. Now both of them came a cropper in this particular budget. So ITC saw some fresh buying along with shorts also getting squeezed out. Fertilizer, of course, took a bashing because nothing came of it in a specific manner. So I think I would definitely concentrate on some of the FMCG names that I have put across. Second is, I think there's a tremendous focus on rural, and that ought to benefit some of the two-wheeler companies. The best in the lot would be two of them. One is TVS Motor. I'm looking at it from a technical angle also here, and TVS Motor chart looks to me to be a very good one. Eicher Motor is the other one, which I think should be a good one. So these two have made consolidation basis and have been given a reason to stage a breakout from it. So I think that also should be a good one. IT was unharmed. There has been a rally going on there, and therefore IT should probably continue. And TCS, Infi are all hitting new swing highs. TCS is at an all-time high. So I would stick with the leaders. Of course, there are many leaders now, but then IT may also be a good bet here. So there are other benefits. So specific to Andhra, for example, maybe NCC, which was in demand yesterday because so much of activity may now kind of happen there. And you had KCP Cements Limited, which went up, and KNR Construction. So there is this state-specific stuff which is going on. I have no clue about which are the companies which will benefit from Bihar. But AP, these are the three names which come to my mind. I think those also could be looked at from a delivery basis.
Okay. We'd love to chat more, CK, and pick your brain on a lot of those other stocks, but we'll have to let you go. Thank you so much for speaking with us, CK Narayanan, with his clear, precise and specific responses on how to play the budget, which has astonished quite a few. Mayuresh Joshi, Head of Research, Market Smith India, with us this morning. Mayuresh, very good morning to you. Are you one of those who were astonished? Good for ITC, no increase in taxes on cigarettes. The other sin, quote unquote, which policymakers have their guns trained on, was definitely taxed. How are you looking at it?
Morning, Tamanna. No, absolutely. I think never expected the changes that were implemented in the budget yesterday to take place. So I think the markets will take some time to adjust in terms of the tax increases that have happened, both in terms of the STCG and the LTCG, as far as equities is concerned. But also, I think we have been working in terms of the real estate indexation benefits, which have now gone off. It is going to have an impact on certain properties with certain time periods, certain holding periods in certain areas that they operate out of. So yeah, I think both these were not expected, but yeah, I think there will be an adjustment phase that the market will now do.
Okay, Mayuresh, very quickly, 30-second answer. Are you changing a stance on any of the stocks? FMCG, for example.
Morning, Niraj. Not really, because I think the earnings will continue to remain steadfast, and there is hope, specifically in FMCG, of a strong earnings recovery if monsoons are normal this time round. And therefore, I think earnings should probably hold up the fort for a lot of FMCG stocks.
Okay, Mayuresh, needed this quick update from you today. Thank you so much for being with us and giving us your thoughts. Really appreciate your time this morning. See you soon.
Thank you.
All right, that's, quick updates on what's happening with trades and with specific thoughts. FMCG clearly coming up at the top. Time for a short break. We'll be back with the pre-open session. Back with In the Market Open right here on NDTV Profit. A quick shout out to everybody who logged into the channel and to our various social media handles. And I would trust you liked the work that we did. Very glad that we were able to give you the kind of information that you needed. We'll continue that today. Get in Chandan Taparia, Head of Technical and Derivatives Research at MOFSL, to talk about his thoughts. Chandan, we'll make this short, we'll make this quick. Good morning and thanks for joining in. How are you approaching trade today? Are you short? Are you long? What's the strategy on any of the indices, be it the Nifty or the Nifty Bank?
Good morning. Thanks for having me. So I'll go with buy on decline stance, looking for 1-2 day point of view. I'll keep the support at 24,200 to play some swing towards 24,550.
So if it's a buy the dip strategy, are the stock recommendations also following on the same line, Chandan? Would you buy them on open, or would you use a dip to get into any of the stocks that you're recommending today?
So looking at the market scenario, it's always advisable to buy the dip given the volatility and the market setup. So two sectors we like now. One is Nifty FMCG, second is the Nifty IT, and third maybe the Nifty Pharma. So these three sectors are now turning in the sector rotation chart. So in FMCG, we can focus on counter like Godrej Consumer Product, Tata Consumer, Dabur. And my favorite pick will be Tata Consumer in FMCG. It has given a consolidation breakout, making high top, high bottom with support of 12.25. It can head towards 13.20 level. We can select one pick from IT. It may be Coforge. Clearly, momentum is visible in the counter. Decline could be bought with support of 6,000. It can head towards 6,500. So one from IT, one from FMCG, and these 2-3 sectors will be on radar during the market hours.
Good morning. What about some of the big plays that we saw yesterday, like your employment generation related companies, TeamLease, etc. Your companies, your pharma companies, which were up because of the cancer drug duty cut. Gold companies or jewelers which are going to get hit today because gold rates completely plummeted after the custom duties were cut. Do you think any of these are interesting for you as per the charts?
Yeah, so we also have positive stance on selective pharma name. And in pharma, we like a couple of names, including your Dr. Reddy, Granules. I believe the positive price pattern and the sentiment from the trigger could take the prices higher. So I like Granules with support of 515. It can extend the move towards 545. Yes, the custom duty is, there's a change in the custom duty, and because of that, gems and jewelry counter could be in focus. So Titan has bottomed out after a long time, and again consumption theme now will be back to on the trade. So with support of 33.85, we can take the Titan for an upside target towards 36.50. So Titan, Granules, Sun Pharma, Dr. Reddy, these are the other names which can be taken from the gems and jewelry and the pharma space.
Chandan, so while you are constructive, a clutch of stocks have come off as well. What is it that if you were long either, you will exit or you would go short? Metals, for example, had an iffy day yesterday. Vedanta 2 in particular cracked about 4% yesterday. What's the view on metals, for example?
So Niraj, I believe that there will be sector rotation in the market. And as per the relative rotation study, which we have done closely post the event, they came out with the conclusion that it's better to look at the sector rotation towards IT, FMCG, pharma, selective banks, while some laggards move may be there in the metal, selective counters from mid-cap, small-cap. So I believe if one can trim down the positions in metal, that will be advisable. As of now, the Hindalco is finding sustained cold writing, trading well below its 50-day exponential moving average. So because that, it can see some more profit booking decline towards 625, 620. Talking about Vedanta, we have seen decline and then recovery, but follow-up is not there till it remains below 445. It can retest to the recent support of 415 level. So advice is to either reduce or better avoid if you have not taken the position.
Just look at what's moving in the first couple of minutes of pre-open, and that's fairly interesting. Not a bad start for the markets. Nifty is down about 60 odd points, exactly as implied open said it would be. But HCL Tech doing fine. DRL, M&M, L&T, some of the stocks that are moving early this morning. Just in terms of from the broader markets as well, Chandan, what would be something that you would pick right now? Would you completely stay away from your railway, defense, PSU stories?
So, like, if I look at the price structure of last 2-3 days, then I might be away from the defense name in defense companies, whether we talk about HL, BL. But overall, major trend is positive, and I believe some more decline could provide the next leg of rally. So it would be very tough in this market, which is having the abundance of the liquidity. But yes, still I believe some sort of pocket may be there. I'll avoid the RBL bank. I believe that Bank Nifty is also finding some hurdle at the upper band of the rising channel. So RBL bank may be one counter which can drip down towards 225 levels. Again, note positive on the selective chemical name, including SRF and all. Major trend is negative and every small bounce is being sold. So I think these are the couple of names which we can avoid, or we can go with the negative side bias of the market.
Thank you, Chandan. It's always great talking to you and getting stock ideas for our viewers. Constructive on defensive names like in HUL, Tata Consumer, Godrej Consumer, and of course, that's the view coming in. But we have with us Niraj Shah, founder and CIO of Envision Capital, now joining in. Hi, Niraj. Good morning. It's Samina joining in. Just a quick reaction post the budget. Are you impressed? Are you disappointed? Are you indifferent? And are you back to business today?
It surely is always back to business at any point of time. So I think it was an important event. The big positive or the big takeaway of the budget is that it really focuses on the real economy. The fact that it reaffirms a higher allocation to infrastructure. It still reaffirms a path which is investment-led to continue to ensure that the economy sustains a high growth rate. Huge amount of focus on urban housing. Energy, renewables. So I think these are some of the great takeaways which I believe will help the economy to sustain the high single-digit growth and retain its status as the world's fastest growing economy. So I think that's really the big part of it. The changes in the tax laws on capital gains essentially are a tad dampening, but I guess it's more to kind of align the tax rates on different asset classes and to kind of simplify the overall tax structure. So overall, maybe in the short term, that's a bit of a sentiment dampener, but I guess directionally, it's probably the right thing to do. So sure. On the whole, very good, very positive. And yeah, I think this just reaffirms the long-term potential of the economy and the ability of our equity markets to continue to outperform global markets.
Niraj, given that all the steps taken wasn't to please a short-term trader, was to, retain sticky money, locally draw some FDI in, so much simplification, and all of it seems like more of a long-term 5-year game plan, right? Now, if you keep that in perspective, the budget, of course, is behind us. Do we now shift gears to earnings, macros, rate cuts? Is that really what business is about right now? I mean, you're still going out there and focusing on those other important parameters beyond the budget?
Absolutely, Samina. Clearly, India remains a very attractive fundamental bottom-up market, while the macros have been relatively benign. But there's a lot of interesting stuff happening in terms of micros, in terms of individual businesses, individual companies, each of them charting their own growth trajectory and making the most of all the reforms that have been happening over the years in India. So I think clearly remain very, very bottom-up focused, looking at individual companies, monitoring the earnings season very well, and seeing whether your existing investments continue to reaffirm the investment thesis and continuing to scout for newer ideas. So I think on the whole, yes, it's back to business, back to earnings.
All right, back to earnings. On that note, Nilesh, good morning. Tamanna here. You think, so two-part question. First, do you think that we're going to see the aftershocks of the long-term capital gains tax tremor in markets today? Or do you think we'll get over it perhaps by midday or end of day? And second thing, when we put the focus back on earnings, what are you seeing? Are you seeing a picture that is perhaps not as rosy as you would have hoped?
Yeah, I guess the long-term capital gains impact has already been, it happened on an intra-day basis, pretty much like what we had last month in terms of the election result outcome, and that came as a kind of a knee-jerk reaction. I think something similar happened yesterday. So going forward, I don't think the direction of the markets is going to get too impacted with the tax changes. It's going to be now entirely driven by the earnings, the valuations, and of all the global and macro events, it's going to be rate cuts in terms of what the US Fed does with rate cuts. and how soon the Reserve Bank of India will kind of resort to a rate cut. I think these are some of the things which will determine the course of the markets.
So rate cuts might be in play next. In terms of this, do you see now a period going forward, Nilesh, where we might not see too much action, a bit of sector rotation, and if so, what would be the strategy here?
Surely sector rotation is overdue. We've seen some really strong performance coming in from the railways, the defense, and the capital goods space. I clearly believe that you are going to see some money being taken off the table, some profit booking happening. I think that's a space where investors have gone in and gushed in with their allocations. So you're going to see some kind of trimming, pruning, or maybe in some cases exit as well from those kind of sectors. And it's going to be back to, premiumization, discretionary consumer spending, some of the financials, fintechs, online platforms, and the tier 2 technology services companies, which are doing very specialized niche work. So clearly seeing the market kind of getting back its focus into those sectors, these kind of sectors. You could call them as a bit defensive, but I clearly believe that there's kind of significant amount of growth happening there. And I expect the markets to kind of realign the allocations.
Mm-hmm. Okay. By the way, the pre-open rates have settled as we speak, and it's a flattish start to the markets, maybe pull up 0.14%. IT banking is maybe a bit hit, about a third, 0.23%. Just want to mark Bajaj Finance and see if that is taking a bit of a knock on the higher credit costs and some of the brokerage cuts that have come in. Not really a knock, just about 1.5%. Suzlon is perking up yet again, so that is doing okay. And there are a few stocks from the fertilizer space which is doing okay. But MGL, Castrol, a couple of others have come off. Nilesh, good morning. Is the 4.9% fisc deficit number the biggest positive of the budget, or is there something else that stood out as well as a big shining positive?
So, Niraj, there are a few. I think clearly the fiscal deficit going at 4.9% and projected to be at, or estimated to be at 4.5% for the next financial year, I clearly believe is the single biggest kind of highlight of the budget. I totally agree with that. This, apart from, of course, local investors and many of the other constituents, clearly international investors do look at this data point very closely. So I think that's a big takeaway. And this aspect, which reflects fiscal consolidation and a glide towards fiscal discipline, that plus essentially the opening up of the Indian bond markets for international investors, and then a possible rate cut, I think on the whole is likely to attract a lot more of capital into the Indian economy. So I clearly believe that's going to be the big takeaway. The second is a reaffirmation of that 3.4% spending or investment on infrastructure as a percentage of the GDP. That continues to be, again, the second most important kind of thing of this budget. The third is, while we have talked about some of the dampeners on the tax structure, but the other positive has been the cut in tax rates for foreign establishments from 40% to 35%. Again, I think is a step towards making India an even more attractive investment destination for global investors. So I clearly think these have been some of the big highlights of the union budget. Okay.
And the other question, Nilesh, is because I distinctly remember we spoke about this. We're just 2 minutes away from market open, Nilesh, so a quick one. But this a lot of talk around why the capex wasn't increased. Does the country have the capacity to absorb a higher capex number because it's only 8 months left in the financial? And therefore, is that a negative for the capex exposed sectors, or you don't think so?
No, I don't think so, Niraj, because the Q1 was relatively soft for many of them. So I clearly believe that a lot of the kind of lagging behind in Q1 will get taken care of in the next 3 quarters from here. So I wouldn't be too worried about that.
Quick take, Nilesh, just before we get into the market open, on whether you would be sitting on the sidelines for the next few days, or you're looking at opportunities.
Not really. I think we continue to scout for opportunities on a day in, day out basis. So honestly, there's no question of sitting on the sidelines. We remain proactive with our portfolios and keep scouting around for newer ideas.
Ideas that are on the radar for you at this stage. You want to tell us what is it that you're watching out for?
So I think in the last couple of days, the renewable companies, the wind power companies, companies which provide the equipment for wind generation energy have come out with good numbers. It seems to be a very, very interesting space. So far, the incremental investments in the wind sector have started to pick up, but still are obviously not going full throttle. We expect a lot of momentum to pick up over the next maybe medium term. So clearly looks like that the outlook for some of the wind equipment companies seems to be kind of getting better and very robust and is becoming a source for allocating incremental capital.
Well, we'll find out the details after this market open. Nilesh, stay on. Remember, Suzlon, one of the wind equipment companies, I'm not saying Nilesh has indicated that, but that is up and about in the session today as well. So do keep an eye out for some of those. But we'll probe Nilesh Shah in slightly finer detail on some of those after markets open. But here's how the markets are starting off a day post-budget. Remember, very choppy day yesterday. Can we see more of the same today? Very likely not. But what is the trend gonna be today, or is there going to be a trend? Well, about 0.15% lower, so no big trends, if you will, just a very flat start. Banks, though, are a bit lower, so 0.38% lower. I believe this is countered maybe by FMCG. I would reckon FMCG stocks could well be in the green again today. Nifty FMCG, yes, 0.24% higher. Let's get the heat map up on the screen. Actually, mid caps, okay, let's stick to the heat map. Tamanna will mark the mid cap and the small cap indices. But fair degree of red, very little green. I'll start with the red first. Bajaj Finance, 2% lower on the results. Tata Consumer, remember, it's not a tradable thing, this whole rights issue piece that has come out. The stock down about 1% or thereabouts. Power Grid, Nestle. So interestingly, while FMCG is doing okay, there are a couple of constituents which are in the red. Reliance is in the red, that's the other one. Banks like Axis and Kotak in the red. What is doing well? ITC, the heavyweight. This is the reason why the FMCG index is doing what it is doing. So after a 6.5% uptick yesterday, another percent added to ITC today. Jefferies has upped the target price and upgraded it to a buy. BPCL, a lot of brokerages are saying that the moves taken in the budget assuage some of the concerns for companies like BPCL. That stock is up. HDFC Life, a clear defensive bent, if you will, because you see a bit of IT, a bit of FMCG, a bit of life insurance thrown in there. But the two winners of yesterday are the two winners of today, Titan and ITC. As we speak, though, the quantum of green is slowly increasing, which is not a bad sign, Tamanna.
I'm surprised that Titan is doing what it's doing. Also because, remember, gold prices took quite a tumble after the custom duties cut, and companies would be sitting with inventory right now, which they have bought at higher prices. So Titan, nevertheless, up there as is ITC. Let's look at how the broader markets have opened today, a day after the big event. And not half bad, at least in positive territory on the Nifty Mid Cap 150. We'll pull up the small cap as well, because even while the frontline indices are in the red, at least these are in the green, not with massive gains though. So broader markets doing okay, at least on first glance. Let's look at what's working in specific stocks, a mix of results, I would say, and budget focus. I'll start with Suzlon Energy, because Suzlon Energy had fantastic numbers. We're speaking to the management in just a bit from now, and that stock up 5% up, second day in a row. Could be twin reasons, could also be because of the focus on renewable energy, etc., which was spoken about by the finance minister, not really quantified though, but the big move is there. See a Borosil Renewable, also second day in a row, doing very, very well. That was a winner right from the get-go. At the start of trade yesterday, continued through, opens another 7% up. So Borosil Renewable, really an exciting one. Let's look at some of those jewelry and gold related stocks. Let's look at a Senko, let's look at a Titan, Kalyan. Those are doing okay today. Maybe the duty cut does help, and hope that you will spur more purchases going ahead. So that is one way to look at it. The fact is that they may be sitting on more expensive inventory, but those stocks looking fine this morning. I want to see cigarette companies. I mean, we saw ITC, but what is the Godfrey Phillips doing? Because remember, no news is good news. Godfrey Phillips doing even better, 1.5%, nearly 2% up. No taxation on cigarettes, because you know what's the new sin in town. Let's look at the employment push, and some of those TeamLease definitely there, Info Edge, and how those stocks are doing. Info Edge not doing too well, but TeamLease and Quest Corp really flying. TeamLease second day in a row seeing a really big push because of all of those employment schemes. I mean, if you have to get interns in as part of your CSR, these are the companies that could provide some of those services, and that's why you're seeing that. I'm going to look at the impact of duty removed on 3 cancer drugs. We spoke about AstraZeneca this morning, but they're not the only one. Dr. Reddy's would benefit, so would Glenmark, Lupin, etc. None of the stocks reacting right now in any major way, though. AstraZeneca looking at a few cuts after yesterday. So pharma having a tough morning out and out. But overall, I would say no big movers this morning, and the market still being quite careful a day after the big event.
Yeah, it's an interesting morning, Tamanna. It's lots of movers, lots of earnings reaction, and this morning for a change, some of those aren't looking too bad. I'll start with Borosil. That's a budget reaction. It was one of your top gainers in trade yesterday. The announcements in the budget have been a positive for Borosil Renewable. The stock is your top gainer, up 7.5%. Tejas Network, third day running, the stock continues to gain, up 5%. Suzlon Energy reported numbers that beat street expectations by a mile. We also will be connecting with the management shortly to get more perspective on the outlook of the company. The stock is doing well, up for a 5% rally yesterday, trades with a gain of 3%. Well, Schaeffler India posted good numbers, 5.5% up move on that counter. Torrent Pharma also reported numbers, so did ICICI Prudential. So if you can get both those counters, we'll get a sense of how the markets are reacting to some of these earnings. ICICI Pru is doing really well, 5% up move on ICICI Prudential. Torrent, remember their VBN margins have dropped, but the value of new business has actually grown, and we've seen a growth in profitability as well. The other one is Torrent Pharma. If I can pull that up on the screen, we should get a sense of what's happening there. But there you go, 3.5% lower. Not sure why the stock is reacting so badly to earnings that weren't actually too bad in terms of early cuts. Parag Milk Foods, DCM Shriram, Thyrocare Technologies. Those are the 3 more names if we can bring up. Parag Milk is up 1.5%. Schaeffler India, like I said, is up 5%. DCM is trading flat. Thyrocare Technologies is also seeing a little bit of stock-specific activity on the trade. 6% on Thyrocare is what we have. Real estate is looking good. Sugar and fertilizers are also not doing too badly. United Spirits reported numbers. The stock is up 3.5%. Auto companies aren't doing too bad either. All in all, the broader markets are looking much better today than they did yesterday. And I think, interestingly, it's FMCG that is seeing profit taking this morning. Dabur, Marico, HUL, barring Nestle, are all down 3 to 4% each. Except for
that's because of the cigarettes. That's because of the
so this is interesting because everyone who came on the channel this morning, even on the technicals, had a constructive call on consumption names. So the trade, while usually is, like CK said, short ITC, buy fertilizer, might have not played out yesterday, and maybe that one leg of the trade still doesn't stand. But buy fertilizer, if anybody's bought fertilizer yesterday at closing, they would be quite excited this morning, I'd imagine.
Yeah, but quite a fall. Actually, it's a good point to actually ask Nilesh on. And Nilesh, while I want to talk to you about those wind equipment manufacturers, a quick question on this this staples trade, right? Yes, currently it could well be people who are making money on the budget trade, booking profits also, but a 5% on Dabur is not just ordinary profit booking. My question is, over a 9-12 month period, do staples provide a good option, or are valuations baking in any kind of positives that come in from a probable consumption uptick?
So Niraj, clearly structurally we aren't very positive on the consumer staple space. Structurally, we like the premiumization story, we like the discretionary spending, we like pockets of consumption where higher aspirations are going to drive demand and where penetration levels are yet way low. Versus that, consumer staples, especially the ones who are basically selling soaps and shampoos, those are not the kind of favored bets as far as our portfolio strategy goes. And if at all, they could just be basically defensive, safe havens. If there were to be volatility in the markets, maybe people might just flock to them, but unlikely that they're going to grow in double digits. Even if you look at the results which have come out over the last maybe 2-3 days, the growth rates have been in low single digits. The only caveat or the saving grace for them could be a margin expansion. If crude oil prices were to head lower, that could drive their gross margins and therefore their net earnings. But that's about it. But if you're really betting on demand, if you're really betting on growth, then there are many better kind of opportunities in the overall consumption basket.
Nilesh, just a question on the big picture over here, because this budget is also being seen as laying the roadmap for what the government wants to do ahead, and the push on renewables, alternate energy continues, right, unabated, though they're not fat allocations this time round. Borosil Renewable is showing that. Are any of these stories something that you are looking at closely? Anything that you're liking in this space?
Yes, so renewables clearly is a space that we like. And we clearly have been evaluating opportunities in the renewable space. Overall, on the whole, we like energy as an opportunity. So we own the largest energy exchange in India. We've just invested into a wind equipment manufacturer. So that's again another one of our most recent additions. So we are very, very constructive. We clearly believe that energy security is a strategic priority for India. And you're going to see massive expansion of capacity happening over the next 5 to 10 years. So in that process, we clearly believe that some of these plays on the energy side are going to end up being huge winners.
Sure. Where does your bias sit in the markets right now? Is your portfolio more tilted towards large caps or broader market stocks, or is it largely a bottom-up approach that you follow?
No, we basically still follow a bottom-up approach. We like the broader market. We clearly believe that there are several opportunities yet in the mid and the small cap space, while of course everybody's been arguing about valuations, but your idea is to find those 20-30 companies in a basket of 3,000 companies where you still see value. So we continue to strive to find bottom-up opportunities in the broader market. We do have about broadly about a 20-25% allocation to the large caps, but it's like kind of a 20-80 or a 25-75 allocation that we have been following.
Very quickly before we thank you, this rounding of the piece on the wind equipment players, because the Suzlon numbers were rock solid. What's the thesis here, and is this a longer term investment bet?
Absolutely, Niraj. I clearly believe there's a runway of growth for the next several years as far as the wind equipment space is concerned. Second is that this space has become now a duopoly. There are only two formidable or significant players here. So to that extent, it's only two guys who have basically the entire cake to eat. Third is that they have delivered, they've basically raised equity, infused capital, paid off the debt, and pretty much become zero debt or close to zero debt, or at least our net debt zero. So I clearly think it's a combination of all three things which will drive operating leverage and financial leverage and drive earnings as well. So clearly the opportunity looks very interesting.
Okay, Nilesh, great having you. Thanks for taking the time out and joining us. Next time on the budget day, we'll see you.
Thank you so much.
All right, that's Niraj Shah of Envision Capital. But we're talking about FMCG. We're highlighting FMCG. Mahima joins in with the brokerage view on the budget announcements around this whole consumption space. Mahima, good morning.
Good morning, Niraj. So while a lot of FMCG stocks are seeing some kind of profit booking today, a lot of brokerages are still bullish on the entire FMCG space. I'll start with the Investec report. They're saying that a lot of things were positive for the urban consumption in the budget, specifically the direct tax benefit in the new regime, plus the direct tax benefit transfers for the first timers. They've also said that ITC and Titan, which are again in green today, are the highest beneficiaries from this budget because of no taxes on cigarette, which is a clear positive for ITC, and the reduction of import duty on gold is a clear positive for Titan. They've also said that higher spending in infrastructure gives more income in the hands of rural population, which will boost consumption and overall boost the rural demand. And they've also said that ENA is out of GST ambit now, which aids costs for spirit companies. Nomura, however, has a contrary view. They're a little cautious on the consumption space. However, they believe that the cut in custom duty in gold is a positive for Titan. JP Morgan says that the standard deduction will support the consumption overall and boost margins for all these consumption companies. Jefferies again has said that they are positive on both ITC and Titan. CLSA says that the focus on job generation will aid the lower discretionary consumption companies. They've said that the employment subsidy plus the cut in tax rate will be supportive of affordable discretionary as well as QSRs and consumer durables as well. Lastly, JM Financial has said that the financial support of setting up nucleus breeding centers is a positive for a lot of companies like Avanti Feeds, Apex Frozen Foods, etc. And the higher revenue expenditure and rise of disposable income will be positive for stocks like Zomato, QSRs like Devyani International, Jubilant Food and GCPL. So this is the overall view of what the brokerages are saying on the entire consumption space.
The market is looking at booking profits on the run-up that the consumption space had seen, and HUL's numbers might have also contributed to that, because the management commentary was not quite that positive, saying that you're still going to be seeing a wait and watch for that rural recovery that everyone's been talking about. We'll take a very short break, but stay tuned. We have a power-packed show this morning. On the other side, Rhythm Desai of Morgan Stanley joins us to talk about his take on the budget. You'll also be hearing from Himanshu Modi of Suzlon Energy. Remember, great numbers on that company. The stock's buzzing today as well. Stay tuned for both those conversations. back. You're watching India Market Open. We're now in conversation with Rhythm Desai, Chief Equity Strategist, India at Morgan Stanley. Rhythm, great speaking with you, and actually great to speak with you a day after. When the dust has cleared, everyone sort of read the fine print and I think got a clearer picture of the good, bad and ugly of all things in the budget. So let's start with that overview. The day after is the LTCG cut looking not as bad, and all the gains expected from employment generation looking not as good. Is that safe to say?
Actually, there was great clarity yesterday itself. So I didn't really need the night to go to the fine print because there is not much fine print here. So there was great clarity yesterday, and that's why the market actually turned. Yeah, the long-term capital gains tax is not a big deal, though I have to admit that I didn't think it this way because I was always thinking the potential risk of 10 to 20, and I didn't contemplate 10 to 12 and a half, which is a pretty okay outcome for equities. With regard to the stimulus for job creation, you're absolutely right. It is quite evident that we'll have to wait to see how things pan out on the ground. But if it does work, I think it's good for corporate profits. So on both counts, I think the clarity had emerged yesterday itself. And thankfully, there's not much fine print in the budget. So these days, the budget documents are far simpler than they used to be 10, 15 years ago.
When you'd see a little bit of red herrings across the way. No, fair enough. That point is taken. But just in terms of the impact for the rural theme, for bottom of the pyramid, for consumption, that's one story that's been going on for a while, was evident even during market close yesterday. Obviously, that sentiment has turned. Do you think that the whole story was overdone, and which is why you might not see that kind of excitement on staples going forward? I mean, of course, from an ITC, which is benefiting because of no cigarette tax hikes.
I think we should actually look at the strategy of the budget rather than going into these, very less relevant nuances. So, if you look at it from a macro perspective, the budget has delivered a fiscal deficit that is lower than what we thought. Kudos to the finance minister for that, because this relentless focus on macro stability that this government has delivered over the past few years is what underpins this bull market. That's the key. So we have another commitment from this government that macro stability remains the key focus, and therefore the bull market is intact. At 4.9% fiscal deficit, 1.4% primary deficit, India is heading into a primary balance over the next 3 years. And of the large economies in the world, it will be the only one with a primary balance. As the finance minister reminded us, this essentially means that government debt to GDP falls, corporate debt to GDP rises, and corporate investments get crowded in. And that's the template to think about this market, about earnings, and about the macro. Everything else is not really relevant. The government did a lot of heavy lifting during COVID. And in fact, in the February budget, the message was very clear that it is stepping aside and now, hoping and letting the private sector come in. And rightly so for the government, because during COVID, private sentiment was very weak. So this budget reiterates that strategy that the government is now stepping away and the private sector needs to fill in both consumption as well as investments. The rural consumption was turning since February. That turnaround is very much underway. So there's nothing in the budget that changes that. With regards to this expectation that this government will resort to populist spending, I think it was a misplaced expectation. And clearly, those investors who hold that opinion don't understand how this government functions. The government and the Prime Minister himself, they are inflation hawks. They're not out here to stimulate things and risk inflation. The key to exiting from poverty is to keep inflation low and keep inflation volatility low, which is what we have seen being delivered on the policy front over the past few years. And that also template remains. So if you ask me, is rural consumption doing well? Yes, it is doing well. Is the budget explicitly doing something to further enhance it? Really not directly, but indirectly by keeping macro stability intact. And rural growth will look much better in the next few months than it has over the past few months.
Hi, it's also Samina joining in, and I've got a counterpoint to what you said. So while we're all very excited about the fiscal glide path and the fiscal prudence that the government is focusing on, but do you think that could have come at the cost of perhaps a cut in expenditure? Because a lot of the government-dominated schemes usually have a booster effect. And I feel like while it's great, that 4.9% number looks great, but if it's coming in at the cost of expenditure, which will have a ripple effect, it may not be so great, no?
See, fundamentally, the government plays the role of providing counter-cyclicality. Okay? So when the cycle is down, the government comes in, steps in. Cycle down in the sense that when the private sector is not feeling buoyed enough to spend. So there are these times when the private sector restrains its spending because its outlook on growth is weak. That's what happened during COVID. So the government stepped in and compensated that. That counter-cyclical support has done its job. The economy is out of the woods. It's on a very strong path. We're the fastest growing economy in the world. There is not that much incremental role left for the government to do. Now the private sector has to take over. This is the recurring message that we're getting from the government, and it is absolutely the right message. If the government continues to stimulate the economy while the private sector is recovering, we will have inflation. Inflation will end the cycle. You don't want the cycle to end. So I think you must understand that there is no other country that has such precise policy responses right now. Such predictability of policy and such responses are not available. If you look at countries around us, they are all suffering from structural or cyclical issues which they are not able to exit. Not India, which is why the bull market is on in India and there's such a ferocious bid on stocks, and why we got a reversal intraday, despite the fact that capital gains tax went up, because it's noise. The real deal is that we have a strong economy with strong policy.
Vidham, good morning. And when I looked at your note, amongst the takeaways, the three key takeaways for the budget, maintaining of the capex momentum, there's a lot of, yesterday I heard a lot of comments about why is it that the number of the quantum of capex has not been increased. I thought it was a bit strange because only 8 months of the year left is only as much that the economy can absorb. Is it because of that, or is it because you are saying that the government wants to send a message to the private sector that we've done our bit, you do your bit now? The point I'm driving to is that this is for this year. Do you think the capex push from the government on the amount that is being doled out will progressively reduce with the years to come as the government tries to send a message to the private sector?
So, see, Niraj, from the interim budget, the government had about 30-35 basis points to play around with because of the extra revenue boost they got from the RBI. They took 20 of that and put it in the fiscal deficit, and they took the remaining 10-15 and put it into some schemes around jobs, etc. So that's what they have done as a very simple explanation for what has happened in this budget relative to the interim budget. Now, we thought that maybe they'll take this 10, 15, 20 basis points and add it to capex. And we were not correct on this because the government has said that, we want the private sector to now do the capex. We have done our bit. So it's a very consistent message from where we were in February. Capex as a percentage of GDP from the government may have peaked in this cycle. And we may be at these levels of, say, 3.5% for a while, and maybe we even go sub 3 as you go forward, because how else are you going to consolidate the fiscal deficit? There are elements in the government's expenditure that are very sticky and cannot be contained because they're not discretionary in nature. Like, you cannot cut back on government employee expenditure, you cannot cut back on defense. Interest expenditure is there, it has to be paid. So a lot of these expenditures cannot be cut back. So how do you bring the primary balance down to zero? And in large part, it will be from discretionary spends, some of it in the form of subsidies and some of it in the form of capex. So that is the roadmap ahead. And in the meanwhile, the private sector will step in and increase its own contribution to the economy.
Sense rhythm in conversations with companies, because I mean, you might be talking to the very large ones and they are doing their bit on capex. I think what is missing is the MSME and the slightly small-sized companies coming out and doing the capex. Do you get the sense that the private sector capex will, which is showing some bits of fits and starts, will really steam up?
I think, Niraj, that's the base case. You have to, so there are a few nuances around this. So let me just highlight what has happened in the last cycle. Private corporate capex to GDP was about 4% in the trough, went to a peak of 17 by the end of the first decade. And then from there, it declined to 4%, in Q2 of 2020 when we were in the depths of COVID. From that 4%, we kind of remained there for a while as we were dealing with COVID. The government lifted its own capex. And now we have come to around 5% of GDP. I reckon in this cycle, we'll probably cross the double-digit mark. So we'll go to 10. We're unlikely to go to the previous peak. And there are many reasons for this. One is that the nature of corporate capex has changed from the previous cycle. The corporate sector is not doing infrastructure spending like it did in the previous cycle. The second is, and this is, I think, one of the big changes that has happened in India and is not often discussed, is that capital efficiency in India has improved a lot in the last 10 years. So in macroeconomic terms, we use a term called ICOR, which is incremental capital output ratio, which is how much capital do I need to generate a unit of growth or unit of output. That quantity of capital has reduced. So we are more efficient as an economy, need less capital, therefore less capex. So that's the second reason. The third reason is that, accounting of capex also has changed. A lot of companies are now charging what is in the nature of capex to their profit and loss accounts. So they're not bringing it to the balance sheet, and therefore the measurement has changed. So given all these changes, the likelihood is that this private corporate capex cycle peak may be lower than the previous one, but its contribution to growth will be similar because of the reasons that I mentioned. So I think we go from 5 to 10. It's very early days. I know we're all looking around for a full-blown capex cycle, but Niraj, that is 2 or 3 years away. You will not ask this question to me in 2027 because it will be very visible to you that there is a lot of capex. Obviously, large companies started first because they have the stronger balance sheets and they have greater visibility, and then the smaller companies will follow.
Right. Rhythm, just one quick question, and I want to try and understand on a specific news flow that came in yesterday. Mudra loans have got enhanced. We are seeing credit guarantee schemes for MSMEs, and that is going to go without collateral. So while this is a good thing for the lower end of the pyramid, consumption maybe to some extent, but I don't know how good this is going to be for microfinance companies. Do you feel like this news, while could work for consumption, may actually fail the banking side?
Actually, I don't think so, because we had great success with this scheme during COVID, and the default rate was very low. People don't default out of choice, they default out of compulsion. So it's only when things go wrong that people default. We're not at that point of the cycle where things are likely to go wrong. So the chances of a default are very low. So this support from the government is very welcome, because if there is any hesitancy from the banking sector to lend, such a guarantee will help them make that decision. And I'll tell you why there could be some hesitancy. The hesitancy arises from the fact that we have just exited from a very large NPL cycle just a few quarters ago. So people are still anchored to that NPL cycle and still scarred by it. Everybody in the system is. And therefore, such support is I think, important to allow people to overcome those scars and start more liberal lending. So I don't think it is likely to lead to defaults so early in the cycle. The risk of defaults increase as the cycle matures, and that's a few years away from India.
All right, so a lot of views coming in there. Rhythm Desai very, very bullish on the budget and all aspects of it. Says the long-term capital gains tax pinch is noise, as he puts it. Well, thank you so much, Rhythm. Great to speak with you and hope to chat with you once again soon. We'll take a very short break. On the other side, we're speaking with Himanshu Modi, CFO of Suzlon Energy. They've turned out great numbers, really a bit of a turnaround story there as far as Suzlon is concerned. What's the secret sauce? We come back with that conversation after the break.
right, Suzlon came out with a very good set of numbers. Revenues were up 50% in line with estimates, but it is the operational metrics wherein there was a significant beat. EBITDA up 78%, margins at 18.2 versus 15.3, as a result of which there's doubling of PAT in Q1 FY25. Himanshu Modi, CFO of the company, joins in to talk about those numbers and the outlook ahead. Mr. Modi, good having you. Thanks for taking the time out. Congratulations on what seems to be a very strong quarter. I mean, was this some pent-up or rollover orders that got executed into this quarter, which were not done in the last quarter or two? Or is this an indication of what is up ahead from Suzlon in the quarters to come?
I would say it is more of the latter. I mean, as we've always met in the previous quarters, our order book significantly ticked up from December 23 onwards. And, of course, whilst execution takes its time to start showing up results, but in the two scenarios that's pointed out, it's not a rollover of prior orders. It is just execution of our order book, which is yet to come. So we have a 3.8 gigawatt order book, which we are, looking forward to rolling out over the next 18 to 24 months.
So what was the execution, pardon me for not having the number offhand, but what was the execution done in the quarter, and what is the target execution that you're laying out for the rest of the year or for FY25 out of this 3.8 gigs?
So we did 274 megawatts of deliveries in Q1, April to June 24. Our estimate, whilst of course we don't give Suzlon specific guidance on what we will do in this financial year, but as a country, our estimate is whilst we did 3.3 gigs in FY24, our estimate is that we do about 4.5 to 5 gigs in FY25. Now, a fair share of that, whatever we could do as Suzlon, out of our 3.8 gigawatt, we will strive to do that.
Mr. Modi, good morning. Tamanna here. So among the other things, you talked about the 274 megawatt delivery. That's, I believe, your highest ever Q1 deliveries in 7 years, along with the highest ever quarterly EBITDA in 7 years. I'm just wondering if this is something that you can replicate in quarter two, since this is the peak that you've hit, and why do you think that this is sustainable?
I think it is clearly sustainable because, as we always said, our order book is there. These are all confirmed orders from marquee clients, both in the IPP and C&I segment. On a large scale basis, the green energy story or the renewable energy story is here to stay. A lot of IPPs or C&I customers have realized that this is the future. Everyone has their own ESG or carbon neutral targets to be met. So clearly, if the industry has to achieve, from a wind perspective, we are at about 46 gigawatts as a country. And the government has set a target to reach about 100 gigawatts by 2030 in the next 6 years. So the entire industry is geared up towards meeting those targets. And as a result, we are seeing significant uptake in wind industry installations year on year. So as I said, we will see about 4.5 to 5 gigawatts this year, which is about a 50% increase from FY24.
Okay. Mr. Modi, you do not give specific guidance, I understand, but out of a 3.8 gigawatt order book, if you've done 274 megawatt, if I just average it out over the next 7 quarters, it would mean 500 gigawatts on average. And I know averages don't work out that way, but the limited point I'm making is that you are on course for a significant uptick from this 274 gigawatt if you to execute the whole 3.8 gigawatts, which means that you will do at least 5x of quarter one or 4x of quarter one in the remaining 3 quarters at the very least. Would that be a fair assumption?
So let me give you another metric.
Sure.
Typically H1, in the historical years for Suzlon, H1 has been about 35% of what we do in the entire year. So of course, half of H1 is over. And when we come back with Q2 results at some point in October, whatever we would have done by September, it is a fair assumption that that would be about 35% of what the entire financial year holds. So I think a more specific estimates would be available by the year end. And I think there are, several analyst reports out there now on Suzlon, which peg the estimates at different levels.
Fair call. Yeah, but I just wanted to hear it from the horse's mouth as opposed to depending on the analyst, because at times, and rightfully so, companies will say that's the analyst view, but our view is different. So best to get the company view. The second question that I have out here is, would all of this execution happen with the kind of operational metrics that you've shown for the current quarter, which is EBITDA margins of 18-19%, part one? And part two, there's a lot of talk of you being a front runner in bagging an EPC contract in Karnataka, which is over 1 gigawatt. Any updates there?
So to answer the first part of your question, whether 18-19% of our margins, so that's a consolidated margin. We have three businesses, divisions, which is the WTG manufacturing, O&M, and our foundry and forging division. So our O&M is, of course, the highest margin. That does about 40 to 43% operating margin. So far as the foundry and forging is concerned, that's close to about 15 to 20% margin. And the WTG business, which will see a significant uptick over the next few quarters, is about in the late single digits, or close to about 8% margins in the Q1. Now, based on how the WTG story plays out and what kind of volumes we are able to do, will define the consolidated margins. But yeah, I mean, somewhere I would say in the mid-teens is where we should be able to maintain our margin with higher absolute numbers.
Mid-teens would be a disappointment, Mr. Modi. I mean, 18.2 versus 15.3. You're saying
that's still, as I said, it won't be a disappointment. You need to look at the three business divisions. And if
but I'm looking at console, Mr. Modi. So console margins, you are saying, would be at about 15% with an upward bias.
Console would be a misnomer because, anything that we do or WTG business, but whatever we do in manufacturing also rolls out into the O&M data. So which is why I said that you need to look at three business divisions. And if the WTG business, which is a single digit margin, is growing in the overall pie, it will have an impact on the consolidated margin. That's how you need to look at it.
Okay, fair call. Just that update on the order win in Karnataka. I mean, the talk is of an over 1 gigawatt order win. You're a front runner.
So, we don't, I don't want to comment on any specific orders till we have that in the kitty. Of course, from time to time, we participate in bids and different orders. Once we have the order wins confirmed with the clients, we will come out with those announcements to the street.
Mr. Modi, a significant portion of orders are coming in from Karnataka and Rajasthan, if I'm not mistaken, about upward of 40% odd. Just trying to get a sense if you see that continuing. Are there more avenues that you're looking at, more states?
So there are other states. Of course, whilst, the activity is, you're right, is fairly high in Karnataka and Rajasthan of our current order book. But states like Andhra Pradesh are also significantly showing an uptick, which you will see in the next few quarters, also having a decent pie in the overall order book.
Let's talk a little bit more about Andhra Pradesh, if you can. More push there coming in for Andhra Pradesh, good allocation in the budget as well. And the kind of sort of policymaker Chandrababu Naidu will want to focus on alternate energy. Can you give us a little more detailing on what you're expecting from Andhra Pradesh orders?
So we already have certain orders that we are looking at in Andhra Pradesh. We are also focusing, on our development business in states like Andhra, Rajasthan, and Karnataka, so that we have enough land bank and power acquisition available in those states, which we can cater to our clients on the manufacturing side as well. So Andhra clearly is one of those states where we see a significant policy push coming in the renewable energy sector. We have had a strong presence in Andhra historically as Suzlon, and going forward, we will continue to look at strengthening that position in the state.
Just one last comment from you, Mr. Modi, on the budget. No clear allocations this time, but the overall motherhood statements on renewable and alternate energy. What does it mean for Suzlon and for the space?
No, I think, the regulatory push and the push from the government of India, as I said earlier, the objective is very clear. We need to get to, as an industry, to about 100 gigawatts by 2030. We have our task cut out as an industry, and therefore as Suzlon, we are all working towards that. whilst budget is an important event, but we don't need to wait for that one single day event importantly, because the year-round policy push and focus on deliveries towards meeting that increased renewable energy target remains.
Thank you so much, Mr. Modi. So that was Suzlon Energy's, top management talking about the plans ahead. And of course, the stock continues to do well. The numbers have been really good. And I think what's interesting, Niraj, is what a turnaround story for Suzlon. Turnaround story is the headline coming out of this. Seemed really down in the dumps at some point. But
yeah, some years ago, yes.
Has really turned around. All right, very short break, but on the other side, we speak with Helios Capital Samir Arora about the budget aftermath and more. We'll also be hearing from S. Narain of ICICI Pru AMC, Neelkant Mishra, Power Pack Day. But we're looking forward to that chat with Samir right when we come back. Watching Talking Point, and we're speaking right now with Samir Arora, founder and fund manager of Helios Capital Singapore, even as we continue our non-stop coverage on the union budget and its implications right here on NDTV Profit. Very good morning, Samir. Great to speak with you. I've been following everything that you've been tweeting, and in the run-up to the budget, you were very, very vocal about how there should not be any regulatory squeeze or any messaging to really shrink the volumes or burst the bubble, so to speak, of derivative volumes. I'm curious to know what you think about what was announced yesterday and how much impact it will have.
No, I'm sorry, but I didn't say that. I was always saying that you have to burst the bubble of derivatives volume. In fact, I was saying it for maybe 6-8 months that the futures and options trading volume is too much. So I was talking only that you should not do anything on taxes, basically long-term capital gains and short-term capital gains tax, because I am in India in two roles. One as the promoter of a mutual fund, but also as an FII, and who has the number one longest track record out of 1.4 billion people, because most others have retired and I refuse to. And I was saying that on a post-tax basis, India will become less attractive. India has done well on a pre-tax index level. If you look at just index level performance of India versus other countries, but if you put a 15% tax average, let's say whatever, some number, and then you compound with that every year, that's every year you're paying some long-term, some short-term, and make whatever assumptions you want to make, that then it will not look as well. It will still look better than many countries, but then it will depend on phases, because last 5 years India has done well, China has done badly, this, that. But over time, your attraction by definition has to come down a little. The most amazing thing I found yesterday was that people were talking and talk about earnings changes of 1%, and that in an IT company, the bottom of the range has gone up by 0.5%, and therefore that will change EPS by 2%. And therefore, people write research reports of 20 pages of this. But when you hit the earnings of the investor, which is the end result of all that research you were doing, by 4-5%, they say it doesn't matter.
Do you think that's what's happened?
1% change in earnings matters.
Do you think that's what's happened, Samir? That because of the changes in long-term and short-term capital gains tax, that earnings of investors have been and will be hit?
No, I won't even mean by do you think. It is just simple. Let's say your earnings were 100 before, and today, and you were paying some combination of long-term and short-term, let's say 50-50, just you can make it less more. So you were paying 10 plus 15 divided by 2, 12.5% tax, and then you were paying 2% surcharge. So your earnings were 85.5, 14.5 tax. Now you do 12.5 plus 20 divided by 2, whatever you want to change that combo a little bit, and then you add 2% surcharge. So your earnings are 82. So it's not the end of the world, but 82 divided by 85.5 is some 5%. So if somebody comes on TV as a professional, as an analyst, as a strategist and says, this is worth 5-6%, that is all. What I get upset with, and unnecessarily even on my holidays, that the guys come and say this is irrelevant. No, it is 5%. And this is more 5% direct than 20 basis point change in earnings growth from 4% to 4.2%, for which the same brokers will write maybe 20-page report and do 5 conference calls, and they say our EPS has gone up by X%, which, by the way, has happened for 1 or 2 years. Means when you do these earnings upgrade, downgrade, nobody knows what will happen in year 4 and year 5 and year 6, because that was not even in discussion. You're talking, there are more marriages this quarter instead of next quarter. Therefore, those earnings have been preponed, so the stock goes up 10%. But when you have a permanent hit, at least say this much. It's not going to change anybody's story. We are bullish on India. That is our business and our job and our life. But to say it doesn't matter just makes me feel that everything else about them is not trustworthy when they come and talk like that, and which is what makes me upset, even though they are my colleagues and some of them are my friends.
Samir, for every investor conference that you and I visit together, we will have this conversation with the sell-side head of that brokerage house about why is it.
There is not one brokerage, there are many. But
I know. Yeah. But Samir, so let me phrase my question this way. One of the beliefs was that the budget doesn't need to do anything counter-fruitful to the equity story, because we are supposedly stretched on the valuations, etc. Now that this has happened, does it cap near-term upsides until earnings prove their mettle?
I agree with that up to a point, because what happened was that if you see the run-up to the, not budget, but generally for the last few years, some sectors had done very, very well and disproportionately well compared to the market. Let's say the infra type or the PSUs or the defense or rail. But they were not like normal outperformance of 5%, 10%, but 2 times and 3 times the market or whatever. And they needed these stories more. they needed the budget to be aggressively focusing on those areas. So for them, I think there'll be a big sector rotation. But the budget was otherwise very, very good according to me. For example, to have the deficit target at 4.9% according to me means that obviously it's very good in a macroeconomic sense. Maybe there'll be an India earnings upgrade. The interest cost and all will come down. I think the financial sector will be a big beneficiary. But the sectors that were doing well needed that thing. Yeah, I don't think that the whole market or the IT guys or the financial guys needed particularly great specific targets from the targeted this thing from the budget. But the sectors that were high flying definitely needed, and I don't think they got that. So there'll be that rotation for sure. Which anyway they needed people needed to move away because the expectations built in were so high, which makes it made it visibly obscene.
So one is the capex theme. Is that something you're referring to? Because that number has been unchanged, or is it the PSU space?
No,
or
it's
some of the
unchanged.
Yeah.
It's unchanged. But you see, if you see year-on-year growth, if the year-on-year growth in these numbers is 5-10%, that is normal inflation-related growth and GDP-related growth, like that 11 lakh crore or whatever these numbers. So those numbers are unchanged, but the market is not unchanged, no?
But Samir, only 8 months left in the year. You think you don't think that's okay? 11 lakh crore for 8 months of allocation?
No, I'm not interested. I don't care about the 11 lakh crore. I'm caring that from a stock market point of view, if your stocks are up 400-500% more than than the market, then your story, your dreams, your expectations have to be constantly on the move up. So, for example, if many stocks in India are up more than Nvidia is up in the last 2 years at least, not maybe 15 years. But in Nvidia today also looks as low P as it was 2 years ago. Our Indian guys, do they look like that? Some of them, not at all.
I suppose especially on rail, defense and those kind of plays, because a lot of the rail budget has gone towards Kavach and security, as it should, but point noted. Are you buying this consumption story, Samir? That the employment moves will now boost consumption and you'll have a better run in staples, etc. Are you buying that story?
No, I don't buy those stories because I don't buy well-penetrated stories. Because what happens is when you are in a well-penetrated sector, then you are relying on India's growth and these very, very macroeconomic reasons that in the long run employment will go up and all that. It's better to buy things where there is some under-penetration, or basically in simpler terms, because the multiples of this sector are very high. I am not interested in stocks which grow instead of 5% volume, 3% volume, which is lower than India's GDP growth in dollar terms, which is say 6-7, and therefore your revenue will grow 8-9%. I'm not interested. At least then you should try and grow 20% in earnings, or 25% if possible. So the consumer we buy, which we call consumer, are these Zomatos and the Varun beverages and stuff like that, which at least we feel will grow high. But I'm not interested in a company which used to grow at 6 saying I'll grow at 8, that the market gets excited that this is an earnings upgrade. For me, even that new number is not a good number, so I don't buy those kind of companies.
So what is Samir Arora looking at right now? A budget, of course, is one event, quarterly results is the other, and in a market which is going to see some rotation, what are you looking at right now?
That is the correct word you used. That is our business model. And we keep saying it to everybody that you are not supposed to define for 20 years what you will buy and for 5 years what you'll buy. You buy 40 companies or 35 companies, from which around 6-8 companies will change every year because something would have changed. Sometimes the budget would have changed, sometimes the focus would have changed, sometimes market preference would have changed, sometimes earnings would have come and the stocks would have become very high. So you change 6-8 stocks on the margin and you are then ready for the next 1 year, 2 year, 3 year period. So we say the long term is a series of 1 to 3 years. In that context, we have already sold some of these infra type, defense type, railway type, and you change a few stocks. Now that we have to figure out which we will do peacefully, whether you buy one more IT or 2 more IT stocks or one more finance stock or some other stock. You change 6 stocks, which you will know because mostly the research guys are common, so plus minus, you'll see that in our mutual fund after 1-2 months. But broadly, you need to change 6 stocks. Therefore, every day to say this is a 100-year story, that is a 40-year story, I don't believe that. I need rotation of 10-15% is required.
Yeah.
And the rest of the stocks anyway continue, not necessarily for 20 years, but they may continue for 5 years, like many have.
No,
That's the model.
that's fair. I'm just wondering where you were on the whole IT cycle. They were least loved for the longest time, have changed, have been back in favor. I was wondering where you've been or how you felt about this.
No, so we are not fully weighted also, because we were underweight for 2.5 years. For 2 years, we were zero from June of 22. So now we have basically one stock we always had, and we bought 1.5. So we are still underweight. That's what I was saying on the margin, because we do elimination investing. We don't think that anybody knows what to buy. We just know what not to buy or what to trim and all that. So in that, it is now in one of the potential things for this rotation, which we will see. But so far, we are not overweight or even market weight in IT.
Not overweight or not even market weight in IT.
As of now.
As of now, yeah. As things stand as of this hour, things will change. Samir Arora, please stay on. We need to take a quick commercial break. Come back and just continue this conversation with you. Stay tuned, viewers. Back with Talking Point in conversation with Samir Arora, founder and fund manager of Helios Capital. Samir, does the FII versus the promoter of the mutual fund in India think differently about what happens post-budget over the course of the next 9 to say 7 odd quarters?
No, that I don't know. But as a fund manager, since I am primarily and actually totally responsible only for the offshore long short fund, my trades and my views are more whether to reduce my net and what to do. And the mutual fund guys are trying to beat a long only index, so they have a different objective. And they might change one stock here, one stock there. I am much more aggressive than them.
What is the aggressive long short managing Samir Arora thinking about right now in terms of changing the portfolio stance, if at all?
So that I've already done, in the sense that my net exposure, that is a long minus short, on around June, going into the elections and even after that, was 75%. Now it is below 60%.
Sorry, Samir, can you explain? I mean, just so are you a lot more defensive?
No, that means I have shorted and I have reduced some of the longs on these extra, as I was telling you, these infra type, whatever, not infra, but capex, infra, whatever you call it. Those I have reduced, not now, that I had reduced before.
Right.
Because I said it on TV also that the expectations were too wild. The expectations were too wild, and even a good budget could have not helped them beyond a point. Maybe then they would have extended by a few days, maybe a few weeks. My problem sometimes is that I am very fast, rightly or wrongly, in analyzing, and sometimes I'm right, but I'm early. And sometimes I'm wrong also. It's both ways. But I'm saying I just do everything fast because that is the way I talk, that's the way I act, that's the way I react, that's the way I am.
Okay. And so, no, which is fair. I mean, as long as it's yielding results and your performance speaks over the number of years. But Samir, the same argument of these extended valuations can be made for maybe some defense names, the shipbuilding, etc. as well, or not quite? Stretched valuations.
I am talking about those names only.
Only. Okay, fine.
Samir, are you completely done with the PSU story? Because this disinvestment hopes
PSU financials.
Yeah, PSU financials you still like?
We have, yes, both.
Okay.
State Bank, Canara Bank.
Okay. And in financials overall, do you think financials?
I still like the financials the most because financials at the end of the day, they are able to connect themselves to whatever good is happening in the economy. Sometimes it's the consumer growth, sometimes it's the this thing growth, sometimes cost reduction. Now for HDFC Bank, it is balance sheet improvement, whatever. They are able to do that, and generally they have a good history, and generally, and I think even this year, their growth will be higher than every other segment of the market, and many of the other segments would not even grow at half their rate. For example, I guess big picture, the financial guys will grow their earnings till maybe 15-16%. Even HDFC Bank will grow maybe 13-15%. And I don't think a single IT guy will grow that much. Or if they grow, they will be considered as the biggest heroes that this market has produced. And the consumer guys will never easily grow like that. The big staple guys, I mean. So therefore, and they have not done well for 2-3 years, but they have done well for us and for the market for the last 25 years. So otherwise, people don't think that these are some unknown fellows and, we are betting or they will bet on some shady unknown names. They have gone through this relative underperformance, and that also driven mostly by the performance of the big 3-4 companies, which is HDFC Bank, Kotak Bank, Bajaj Finance types. But the rest of them actually have also done well. So therefore, we always like and continue to like and continue to justify to ourselves are overweight in financials.
Okay, so financials is overweight. I wondered if you have a view on real estate after this removal of indexation. I think people are still trying to figure out.
No, that actually, I don't think it. We don't have, by the way, even one real estate company right now, but I don't think it is bad for real estate. We had it, but we sold it about a month, 2 months ago because it was just too much. Everything has, and actually the stock, the big one hasn't gone up for the last 2-3 months anyway because we can see it. That it's too much. Something has to give up, and every time you announce a project and then you sell X thousands of crores, then next quarter you are supposed to sell 2X thousands of crores. How can it go on? We also know broadly how many people are there. And even yesterday, by the way, I saw one interview. Maybe they came on your channel, I saw on, I think, another channel, basically saying that I am now hoping that investors will come back into real estate. Excuse me, we always thought all our life, that end consumers are supposed to come into real estate, and when investors come, it is going to end in a problem, as it has always ended for the last 5,000 years. So you don't want investors. Even I don't think the government wants investors in real estate, because one of the objectives must be to lower real estate prices so that people can afford. For example, in Singapore, if a foreigner now buys real estate, there's a 60% tax, which used to be zero, so maybe 10 years ago. So the idea was to make real estate prices low, for somebody to feel proud that now investors will come into this sector, means that there is nothing much. But I think otherwise, I don't think it is bad for the sector. It is bad for the old properties where, some trade-off will be there, whether this scheme is better, that is better. But what is it? That is history. Those guys can make less or more. It doesn't change the dynamics for the new guys. From the new guy point of view, the tax might be better off only, I think.
So real estate was never something.
But what I'm saying is you can't make that story that we will now get speculators into our market. I mean, how can that be a presentable story? But people talk different things when.
Okay, so the one big idea, Samir, and while we let you go, and always fascinating chatting with you, the one big idea, the one big trigger that now that the markets will look like, elections are done, budget is done, Q1 earnings, of course, we'll have to wait and see what the full picture looks like. What's next?
No, actually, I don't think that every day you need a trigger. You basically need that the earnings should come through and your valuation should not be so high that those earnings growth gets wasted. Let's say, for example, Bajaj Finance last 2-3 years, their earnings grew. But because at that time the valuations were high or whatever, maybe hindsight, maybe that time, right or wrong, somebody may have thought, but you did not get that in your stock market returns or in your stock gains. So that is the issue with all these sectors and all. Many of them will grow and many of them will grow less. You want that you should not waste that earnings growth by having valuations which are very high. Therefore, I am not saying, and I don't think anybody is saying that this market is very cheap or that, but I don't think it is expensive. It is that a plus minus the earnings growth you will get. But since that earnings growth was 10-12%, and then you put in a tax which makes India relatively unattractive, you lose, according to me, 4-5% for that. Now, whether you actually lose it or that also we hype because our mutual fund guys are getting money, it's a different game. But please, one thing I should say, big picture. Let us not think that there is only one country in the world. I only invest in one country. That is my job, and for 30 years I've been doing it. But realistically, please understand that there is not only one country. Just yesterday night, not even day before yesterday night, Google, which is a $2.2 trillion market cap company, which means 45 or 50% of India's market cap, grew its revenue 14% and its profit, I think, 28%. So in theory, a global investor could, instead of putting money here, could put, they put 2%, they could put 1% more in Google, they will get higher growth as of today. And that higher growth has been there for long. They will always be able to find 20 companies. So I'm saying big picture, let us make India at least tax neutral, ease of accessing neutral. Then everything else is in our favor and we are the biggest beneficiaries if the market does well because of this thing. But on the margin, in the short term, for the next 2 months or 1 month, I have reduced my net. So I'm telling you that today, otherwise it looked like all these other guys were talking about 20-year stories, which is true. It's a different story, but there are 20-year stocks in the world also.
20 years is a different story. Thank you so much, Samir Arora. Always fascinating chatting with you, founder and fund manager of Helios Capital, on the budget and how he sees things panning out. So all the time we have. We'll take a very short break, but stay tuned. A lot more on the other side.
Benchmark indices come off day's lows. Sensex trades about 80,300. Meanwhile, the Nifty trades near 24,500. Most sectors trade in the green, led by oil and gas and media. Meanwhile, FMCG and financials trade with cuts. And ITC shares rise to hit a new life high as tobacco tax is left untouched. Jefferies upgrades the stock to a buy rating. An FMCG giant HUL trades lower after the company reported its June quarter numbers. Company sees a gradual improvement in rural demand.
Welcome. You're watching the F&O show, and it's an interesting market. The budget is behind us. The Nifty trades flat. It's volatile, but in a fairly tight trading range from the way we look at it. 50 points off on the index, which isn't too bad, given that most people believed that the increase in LTCG and STT tax could have had a material impact in terms of sentiment, at least. The breadth of the market, as it stands, if you can quickly pull that up, is more or less a 50-50 picture. You've got a handful of gainers and you've got a handful of losers, so there you go. Actually, no, the breadth is not too bad. The breadth is far stronger than what we are on the advancing side as opposed to declining counters. In the broader markets, there is an interesting play that's taking place, 0.2% higher on the Nifty 500. All through the morning, you had aggressive buy calls coming in on the consumption pack. But contrary to that, the consumption space is not having the best day in today's session. Some profits being taken off the table after yesterday's big run-up. Sectors that are moving today is a little bit budget-focused. So stocks like Borosil and Avanti Feeds are doing well, and Adani Wilmar, a few names that were beneficiaries of the budget. Apart from that, fertilizer, sugar and railway that have been selling off for the last couple of days have seen a little bit of recovery in trade. But of course, we will be getting budget views and budget opinions from the stalwarts of the industry. We have one that we will dip into in just a few minutes. But before we move to that, what does this increase in STT mean for traders? Sajid is standing by with more on that. Sajid, for a layman, the increase in STT might not be significant, but if you're an intraday derivative trader, the impact could be pretty large, I'd imagine.
That's right. You have to break it up into two factions. The first one being the kind of cost which is there for transaction and basically STT from a retail point of view. If you look at what has happened is that for a trade of 1 crore, especially in options, the price has gone up. The kind of STT that you have to pay has gone up to nearly 10,000 rupees per crore, and that's from 6,250 rupees. And the same for futures has gone up from 1,250 to 2,000 rupees. Now it looks big on a trade of 1 crore, but if you look at the market breakup, a large portion of that is done through proprietary traders, and then you have what you call the retail traders, and that's where a lot of volumes are coming in, and that's what is the cause of worry for regulators as well and the government. The average ticket size there, or the trade size there in FY25, it's nearly 6,000 odd rupees, and the cost for them has nearly gone up by 2.3 rupees per that average ticket size. So that's very minuscule for them in the entire scheme of things. If you look at how a trader would be doing it, they may be buying one contract or two contract, and then paying the premium on it, and on that 2 rupees is not going to make much of a dent. But on a quantum wise, the STTs have gone up by nearly 60%. The government has increased by 60%. And the government is aware of the fact that even though they have increased by 60%, it's not going to make a significant dent, because now the next step has to be from the regulators, who are going to bring in some kind of restrictions or curbs for retailers to, or make it expensive for the retailers to do it. My understanding is that because of a lot of chatter which has been happening on F&O, there is a regulatory committee which has been formed, and SEBI has a secondary market advisory committee which has already recommended to the board or to SEBI, and now SEBI is working on the final contours of the consultation paper which will come out soon. And as part of that consultation paper, the first thing which is there to increase the lot size by 4 to 5 times. So if you're looking at today from a retail point of view, if you're looking at 6,000 being the trade ticket size, that may go up to 25 or 30,000. Now that becomes a bigger chunk so you have the fringe people on the fringe moving away from it, because now the cost of trading in a contract goes up from 6,000 to 30,000, and when you do that, there's a corresponding impact on the margins that they have to place in, and that also brings in more. And then the cost of trading also goes up, because the trading what you do give it to the brokers is not based on contract but on turnover. So the turnover fees also goes up, and then you have the stamp duty that goes up, then you have the brokerage that goes up, everything goes up, and that increases the cost of doing a trade for Indian F&O market. Proprietary traders may not be impacted much because they don't have that kind of cost structure there, because they are using their own books to do it. But for retailers, it will impact if all these things come together, because STT is going to come from October 1st, and likely that if SEBI brings out the consultation paper and finally it implements it, it's assumed that by the third quarter of this calendar year it will come into play. So both of them coming together into play will cool down some bit of volumes in the market that's expected. But the total revenue, assuming that no volume is going to change based on what we have seen in April and May, the addition is nearly 5,000 crores for the government. So that's minuscule amount of revenues addition coming to the government. Right. But the impact is something which is more important to look at.
And especially because the difference between a profitable and a loss-making trade is so marginal in that sense, right? It's largely expenses that make you a successful intraday trader or not successful intraday trader. But there will, I'm sure, traders, the brave hearts will find a way around this. They'll pick up strategies and derivative calls and stocks that may actually help them make more money on smaller or fewer trades. So I think we spoke to C.K. Narayan this morning, Agam and Sajid, and they both mentioned, he mentioned that one, you could look at trading liquid F&O stocks. The other one is trade high ATR stocks, which is choose to target higher average true range stocks. These stocks display bigger intraday moves and therefore give you better odds to trade to capture bigger profits. So maybe that could be one way of...
Yeah, no, and I just wanted to clarify for those who are not well versed with average true range, it's nothing but another measure of volatility. Average true range is actually just an average of your high minus low over a course of the last 10 days or 20 days, whatever you want. Or, of course, it's taken with respect to the previous close or the previous day open as well. But
so
that's
also
largely
a swing trade. Is that is that another version of it?
In general, average true range mostly basically just gives you how volatile a particular stock is, and that's exactly what C.K. Narayan said.
And he also talked about high RSC stocks. Now, these are higher relative strength comparative with other stocks. These also help because there's a stock shock proof during turbulent times. They make bigger profits. We need stocks that rise faster than the broader market. So that's another strategy. These are things that are not used very commonly by people who may not know very much, but by experienced traders, these might be ways to work around it. But of course, like we said, we are not encouraging you to do this if you don't know it, but maybe worth giving it a thought of ways to find ways around higher.
A financial planner.
Yeah, please consult a financial planner or RIA at this stage. But this is our little takeaway from what our guests have said. But sticking with the budget theme, my colleague Muralidhar Swaminathan is in conversation with ICICI Prudential's AMC's S. Narain on the budget and the impact of STT hikes on the F&O volumes. Listen into what S. Narain has to say.
We have had tremendous sustainability in terms of growth, and we are the fastest growing. But in terms of jobs, there has been a huge problem. The budget this time around has specifically taken the route of incentivizing employers to generate jobs. What are your thoughts on this?
I think it's a fantastic step. I think, we have to encourage job creation by employer. Encouraging job creation by the state government or central government is not the way. I think the step that the government has done this time, both through the apprenticeship process and the other process that they give incentive for the companies to hire, particularly people who are paying less than a certain amount, is the right way forward. And I think the model is absolutely correct. And logical at this point of time, and that is the right way. And I think we are very, very impressed by the way that government policy has been done in this budget in this area.
And that will lead to skill development, which is much required, I suppose.
Yes, absolutely. If you look at all the areas where we have actually gained in skill development, whether if you look at IT or whether you look at chemistry and drug area, all these areas, the skill development has happened because of these kind of things, and the step taken by the government this time to do it is, I think, a great step in the long term. Whether it will help in the next 3 to 6 months, it may not, but I think this will clearly help in the long term.
Okay, the other key area which is very critical for India to unleash its potential is the MSMEs. This budget is again focusing on MSMEs, especially their credit needs. Now that's a huge problem for MSMEs. Now their cost of credit, even during normal interest rate regime, is very high. What are your thoughts on this? How do you think this will help the MSMEs unleash their potential?
I do not know. Maybe, I've worked for 35 years and we've seen in 90s people paying 16, 17, 18%. Today, even the MSMEs, many of them, which are financially in good shape, I think they pay a single digit, 9.5%, 10% maybe. So, I think it is important for MSMEs to practice good financial management and have good balance sheets. And if they do it, I think today there are so many providers that their borrowing costs are also more reasonable. I've seen unreasonable borrowing costs in 90s. I don't see that at this point of time. I think the challenges come to MSMEs if they don't have good balance sheets and they do not have good profit and loss account. And, I'm not very clear what should the government do, what should the lenders do with all these kind of MSMEs. And if they have competitive advantage and they are actually going through only a temporary downturn because of some industry-related issue, then it is fine. But if they are actually uncompetitive and they do not have any competitive advantage, should they be lent more and more money to just survive or prevent them from dying? This is a question I do not have clear answers to.
Yeah, very important thought. I think, again, as you rightly said, it's not just making funds available, they should be competitive. But as an aside, still investors love to invest in small and mid-cap stocks. That's where they are making a lot of money.
Yeah, but when the government talks of MSME, they are not talking of that segment. They are talking of a segment much below that. Today, if you look at mid and small cap stocks today, most of them are able to do QIPs, they are able to do disinvest, they are able to raise money in the form of fresh equity very, very easily. So for them to raise money is not a problem at all, but they are not the MSME. I would say they are one step ahead of MSME, they are much bigger. And in SME IPO, where we are not participant, I think we are seeing some excesses there in equity valuation there, but the problem is not lending there. The worry for me is the equity investor there, and there the challenges we are worried about is the retail investor who is investing in the SME IPO. Mutual funds are not connected to that segment in any way, but there we are worried about the retail investor there, not about the issuer.
Okay, well, that's S. Narain for you, and we can, of course, continue to see that conversation on NDTV Profit, but we put the spotlight now on the futures and options space, and we have Akshay P. Bhagwat of GM Financial and Ajit Mishra of Renicor Broking joining us on the show. Good morning to both of you. Thanks for joining in. Akshay, start with you on your view on the benchmarks. How are you treating them now that we have this big event behind us? What's the way forward here?
Good morning, Adam. Yes, the big event is behind us, but still the market is in the process of digesting how to go about ahead post the event, because still there is no clarity as to how exactly things will unfold. There is a mixed reaction, as I understand, going by yesterday's trading, and the tilt is still on the negative side. As far as the levels go for the Nifty index, 24,600 basis spot Nifty is a very crucial resistance zone from a short-term trading perspective. This has to be overcome for any kind of recovery in Nifty. Until then, considering the weekly expiry tomorrow, the range which I foresee in Nifty is 24,000 on the lower end and 24,600 on the upper end. So it's a range bound scenario for the Nifty index, but there is more clarity on the bank index where there has been a breakdown or a negative short-term development as the 52,000 level has been breached in yesterday's trading session. Short build-up has been noted to some extent, and the downside supports are seen at 51,000, that's the first support, and 50,500, that's the second support. So more clarity on the bank Nifty on the sell side, and Nifty it's going to be more of a choppy range-bound session.
You're right. Bank Nifty expiry is also on the 31st of July, so it is, and it remains fairly volatile. Ajit Mishra as well joins in. Ajit, let's start with the index call first. What is the strategy on the Nifty and Bank Nifty?
Yeah, good morning, Samina. So, Samina, this 3-4 days of move. One thing is pretty evident that market is not in the mood to lose control, especially the bulls. And the way we have been holding this 100 days of this 10 days of exponential moving average on the closing basis, that clearly indicates that bulls are trying their all their ammunitions to assure that they maintain this level and again resume the uptrend. But having said that, we are seeing negativity in the banking space, so that is basically weighing on the sentiment, and plus sectors which were doing well and helping the index, like FMCG and selectively IT also, they are slightly on the back foot today. So I feel it could be a lackluster session today's trade for the index, wherein 24,550 is going to be the area of resistance, and downside around 350 to 300 is going to be the area of support. So for a time being, it's prudent to avoid any positioning in index, and if you wish to hedge your position, then definitely you can go ahead with shorting position with 24,550 being this stop. Banking, on the other hand, looks comparatively weaker because the private banking majors, such as ICICI, which were holding strong, they have started seeing some sign of profit taking, and that might continue for a time being now. So 51,000, 51,100 is the area basically where we have the next major support for the banking index. But here also we feel that one should wait for any rebound to go short in when it comes to the banking index. So currently we are at 51,400, 50, 60 zone. So any recovery towards 51,600, 700 zone, then one should look for shorting opportunity with 52,000 being the stop.
Okay, well, that's as far as your indices are concerned. Akshay, coming to you, stocks on your radar this morning?
Yes, I'm looking at the pharma sector because there are green shoots here. It's more of a defensive bet which the traders are preferring given the current slippery nature of the market. Here I'm looking at Aurobindo Pharma, which you can consider as a buy recommendation, but I would use the options route to take this buy call. My target is around 1,400 in the month of August, in the first week of August. So I would be playing with buying of 1,400 call for the August expiry with which is currently around 34 odd rupees premium. I will target 57. That's my first target. 72 will be my second target, and the stop loss on this trade would be 19 on the option premium. The second trade is in the life insurance space. HDFC Life Insurance, a very strong price structure as I see today. The prior swing high of 650 has been breached in intraday trades. Long additions are piling up in the month of August, and 687 and 687.70.
Right.
Okay.
Akshay, we can't hear you. Akshay, we cannot hear you. You were talking about HDFC Life. Can you try giving that answer again? Yeah.
Sure. So HDFC Life is my second trade recommendation. Swing high of 650 has been breached today. Strong buying in the derivative segments are piling up for the month of August. This stock is potentially heading for targets of 687 and 705 in the short-term scenario. Stop loss on this trade would be 641.
Right. Ajit, what about you? What are your top stock recommendations today?
Yeah, so first that we have on the list is NTPC. The stock has made a new record high. It's been almost like 2 months of consolidation, and in the entire recent profit-taking phase also, NTPC was holding strong. So we feel that this recovery is here to continue, and in fact, we can see much higher levels. So 402 is what we are eyeing as the immediate target, with 384 being the stop. Another stock that we like is from the pharma space, Sun Pharma. So again, a strong pivot formation after marginal retracement while holding of the short-term averages. And now the indications are in the favor of a newer high in days to come. So 1670 is what we are targeting for the immediate future, with 1590 being the stop.
Right. Thank you very much, Jeet. Akshay, good talking to you. So 2 trades coming in from the pharma pack, 1 from the insurance pack as well. We'll slip into a quick break. We'll come back, and as always, with the focus on commodities. So stay tuned.
Welcome back. Let's talk about commodities now. We have Vandana Bharti of SMC Global Securities joining us at the moment. Vandana, morning. Thanks for joining in. Vandana, there's been a lot of talk about gold in general, specifically and especially after yesterday's union budget presentation. What's the way forward here, and how are you trading gold?
Yeah, hi Agam, good morning. So it was in long demand that the import duty should be cut down by at least 5%, but it was a surprise. It was cut by 9%. So market reacted in the base, and now the base price of gold and silver, they have been changed now. And now the domestic gold and silver prices, they should align with the international market. In the international market, I'm expecting that the prices should move up marginally here. And if we talk about COMEX, the range should be of $2,400 to $2,440 on the higher side. On MCX, I'm a buyer in gold for it could be a swing trade. So one should go for a buy here at the level of 68,800 for the target of 69,000. For the stop loss of 68,700, but ultimately the prices should come down maybe on Friday towards the level of 68,000 here. So yes, for intraday, it is a buy call for gold, but in short term, again, the more correction should come in gold.
Okay, that's the view on gold, Vandana, but how are you trading crude?
Crude oil, it is moving down, and it has taken good support near 6,400 yesterday. And below 7,500, it is not okay for OPEC. And from there, we generally see the announcement of production cut and all. But yes, for today's trading session, we may see some kind of here a selling pressure again. And 64, it is a very good level where we can see a selling pressure for the target of here 6,400 with a stop loss of 6,520. Today night, we have inventories data from US, and we are expecting a weaker decline in the inventories. That will be again a negative for crude oil prices, and dollar index is moving up. So these two bearish factor may exert some pressure on the crude oil prices, and again 6,400 is expected on MCX in crude oil.
All right, Vandana, finally a word on natural gas as well.
Yeah, it is continuously in downtrend, and a few days back it tried to get support near 170 level, but yes, it moved on weather forecast and inventories, and both are indicating that there should be some bearish pressure on natural gas prices. So even in option, it is a sell call in natural gas. If we consider the futures July contract, one should go for sell here. Current contract once near the level of 179 for the target of 172. We should put a stop loss of around 181, and finally it should take support near 170 level again. But for the today trading session, it is a clear sell in natural gas.
Okay, Vandana, we leave it at that. Thank you so much for joining us and taking us through your views on those specific commodities that we've spoken about. And with that, it's a wrap on this edition of the F&O show. But Indiabulls Housing Finance Limited is now Samman Capital Limited. Jio Samman se. Keep watching NDTV Profit for all business and stock market updates.
Welcome, you're watching the Small and Mid Cap Show. I'm Mahima Vachajani and with me is Varsha today. Well, before we speak to the managements that we have on the show, let's take a quick check on how the markets are panning out at present. Well, in terms of the benchmark indices, the pressure is there. However, it is not as bad as it was yesterday. Nifty 50 is down around 0.09%. Let's also take a quick look at what Sensex is doing. Pretty much in line with what Nifty 50 is doing. It's also down around 0.1%. But let's take a quick look at what broader markets are doing. Well, the broader markets are clearly outperforming the benchmarks today. The Nifty Mid Cap 150 is up around 0.9%. Small Cap 250 is up around 1.6%. Let's also take a quick look on the contributors on the Nifty today. Well, something like RIL, ITC, Tata Motors, NTPC is something that's pulling up the Nifty, but something that's weighing down the Nifty is a lot of banking names. In fact, all names, all heavyweight banking names are weighing down the Nifty. ICICI Bank, HDFC, Axis Bank, Bajaj Finserv, Nifty Bank, all constituents of Nifty Bank in the red, Bandhan Bank, Axis Bank, ICICI, SBI. Let's also take a quick look at the breadth of the market. Despite yesterday's slowdown, the breadth of the market is skewed towards the buyers today. The ratio is almost 4:1 now. Around 1,600 odd advances and 400 odd declines. In terms of the sectoral performance today, the gainers on the sectors today are the Nifty Media, the Nifty Realty, and Nifty Energy. However, there is pressure seen in banks, finance, and FMCG. FMCG, we are seeing a lot of profit booking today. It's the pure profit booking play for FMCG. However, there are names like ITC and Titan which are still gaining on the back of the budget news that we had yesterday. However, today we're going to speak to a very interesting management today, and we're going to talk to Mr. E.B. Rao, Chief Operating Officer of Kernex, who joins us on the show now. Mr. Rao, welcome to the show. My first question to you is, with the overall performance of Q1, of course, give us some color as to how Q1 has been for you. And, I also want to understand that, you'd guided for a revenue target of 130 crores in FY24. However, you ended up doing 20 crores. So going forward in FY25, what is the kind of guidance for revenue that you'll give? Is there any change in the number that you'd guided for already?
The initial stages in Q4 of last year, there was the limitations in TCAS design requirement and the product development stage. So that's what we could not achieve the projected figure in last quarter. I mean, that is final quarter of the last financial year. This financial year, those things are resolved, and we are hopeful of receiving the targets which we have planned of 450 CR.
So are you saying that in FY25 you will be doing around 900 crores?
That is expected, but it is depending on the projects upcoming. You see, railways is planning in big way. If it is happening that what they have assured, then we can achieve. If not, we may.
Sure.
Right.
Go ahead.
So if not, you say they have railway board and railways are planning for issuing the tenders in the month of July, August, September. So if it is happened, then we can achieve this revenue this financial year, that 700 to 800 crores revenue we can achieve.
Right. So from what I understand is that FY24 ended with a 20 crore revenue, but if if tenders are done properly and if you get those tenders, what you're expecting is 700 to 800 crores of revenue in FY25. Am I right?
Yes.
Okay. And apart from that, what other levers do you think will aid the revenue growth from 20 crore to that 800 crore mark? And where do you see your margins and bottom line going then?
You see, this 20 to 700 crores is the dependence on the projects tendered by the railways, right? Second is the implementation. Third is the clarity or design freezing by the railways. So those things now resolved. So I have no doubt or the skeptical about the revenue generation. Now those issues like design implementations, design modifications, product fine-tuning is done. So I am hopeful we are optimistic we will achieve those.
Also,
and 20 to 700, you say last year the first initial stages of the project. Now railways is coming in big way. So we are one of the OEM. So we are hopeful, and that is the reason we can achieve 200 to 600 700 CR.
Also, I just wanted to touch upon your order book. So as on today, what is your order book standing at?
You see, we have now 6 projects. In that, total order is 673 crores. In that, Kernex portion is 501. Remaining is our JV partners.
So I am assuming this would be executed in maybe, in next 1 year?
Yeah. Yes, this financial year, 80% of the things will be done.
Right. So Mr. Rao, then, so if from what I understand is that from that 500 crore of order book, which is completely of Kernex, 80% of it will be executed in FY25. So that is roughly 400 odd crores. So from that, so I still want to understand. So then 400 odd crores to that 800 crore mark. Will that gap be filled by the tenders that you'll receive from the railways this year?
Yes, yes.
Okay, and in the budget, yesterday's budget came in, and Ashwini Vaishnav has allocated roughly 2.62 lakh crores for railways overall, and for overall safety measures, 1.08 lakh crore has been allocated. So I want to understand that from this 1.08 lakh crores, if you can give us some understanding, how much of it will be allocated to Kavach, and how much of a tender conversion are you expecting from that entire amount?
You see, in railway safety system, there are many things. One is signaling system, in electronic interlocking, train collision avoiding system. So we are related to train collision avoiding system. With reference to railways and the discussions, we are expecting around 10,000 CR tenders in the month of July, August and September. In that, 3 OEMs are there, which we can share it and bid and get it. So Kavach alone in this year, as per our expectation and as per things going on, total maybe around 10,000 to 11,000 crores this financial, they may call for tenders. In that, we are one of the players in Kavach system. That is one. Second is in safety system signal, we have entered recently with the absolute block signaling system with one of our partners. So we are planning to explore those options also.
Okay. Also, we are seeing this lot of accidents going around, and where is it that we are lagging? That the installation of this Kavach and safety measures, I mean, we are lagging behind. So, any reason for that?
You see, this SIL 4 system, this one, safety integrity level number 4, and railways and even the OEMs require a lot of time and repeated tests and the certifications. These are the things which is causing delay, because here one product is not involved. Here multiple products. You say onboard equipments, station equipment, radio components, and traffic control room systems, all this to be developed and then integrated and safety validation to be done. So hence, it is taken long time by all stakeholders, RDSO, railways, OEMs. These safety systems will take time. Even if you take the ETCS2 or CTCS3 earlier systems of European and Chinese also, they have taken this sort of time.
Also, lastly, on the competitive scenario, so we said that there are 3 players currently in the industry. Any chances or any possibility that more players will come into this industry?
Yes, there. You see, 2 more are expected in this financial year as per the developments happening. So there are 2 more OEMs are expected this year, and the next year and 2 more or 3 more may be added.
Okay, Mr. Rao, so in total you're expecting that in next 2 years, 5 more companies will be competing with you for the entire safety, railway safety equipment space. So then do you see yourself losing market share to all of these new companies that will, come into picture?
No, there are two things. TCAS is one of the safety system, but TCAS alone is not a safety system. Yes, in TCAS 2 more will be added. We are planning to expand ourselves in ABS also. That is absolute block signaling system. Second is centralized traffic control we are planning to enter. To compensate this, you say there is now 3 people, in the coming year 5 people. So we can't lose the business, so we are expanding because the safety systems like a CTC and then absolute block signaling system are similar. Not same, but similar, so we can expand. So I have no doubts why we should.
Understood. Well, Mr. Rao, thank you so much for breaking that down for us, and all the best for the future. I hope that you reach that 800 crore mark of revenue. But with that, it's time to slip into a short break. Up next, we'll be joined by the management of Indian Overseas, so stay tuned.
Welcome back. Thanks for staying tuned to the Smaller Mid-Cap Show here on NDTV Profit. Well, we have with us now Ajay Srivastava, MD CEO at Indian Overseas Bank, to talk to us about numbers and Q1 results. Welcome, Mr. Srivastava. First off, I want to try and understand the margin profile that one can expect going forward. We've seen a bit of, fluctuation when it comes to margins over quarters. So talk to us about where should margins settle in and what are the variables that are affecting it?
The margin which we are looking at and we have planned will be around 3.10 for this financial year. And March was an aberration because of one time some increase were there. Because of that, NIM improved to 3.53. But going forward, the stability will be around 3.10. And the major factor which is impacting NIM is, of course, deposit cost. There is hardly any money in the market, and it has become very costly. And we at IOB also, we are looking at this situation. We envisaged it at least 15 to 18 months back, and we came out with a deposit plan of 444 days, special deposit plan, in which we are giving 7.30, which is the highest in the system. And since this scheme is in place for last 15 to 18 months, the cost has already been factored into this NIM. And the cost of deposit, even after doing this 444 days deposit, for the month of June, it was at 4.95 only, well below 5.
Got it. And sir, just with regard to deposit costs overall, if I can cap this point. So you believe that deposit costs have now peaked, nothing to be repriced as of now?
Repricing has happened over last year to a larger extent. Still, a part of that is still there in the system. Maybe another 4, 5, 6 months it will go on.
Okay.
And for one more factor for IOB there, which is very critical, is that on a continuous basis, we have been maintaining our CASA ratio above 42%, around 42, 43%.
Yes.
And despite all the challenges, we have grown in CASA year on year. If you see June to June, we have grown by almost 8% in CASA. And in this financial year also, Q1, sequentially, if you can see, March over June, we have been able to maintain the level. We have not gone down.
Okay, and with regard to where growth goes from here, talk to us about what the loan growth expectation should be, what the deposit growth expectation should be.
Loan growth, we are planning to grow by around 12 to 13%.
Okay.
Deposit growth last year, if you see June to June again, year on year, we grew by 13%. This year, looking at the challenges ahead, we are planning to grow by around 11 to 11.5 in that range only, deposit growth, and credit will be around 13% growth. Our CD ratio is at 77%, which is very much comfortable. So that is the plan for this year.
Got it. And sir, you've spoken of 4 to 6 more quarters of pain when it comes to cost of deposits.
4 to 6 months. 4 to 6 months.
Yes, 4 to 6 months. Yes. So does that mean that your margins, which are currently at 3.06, what gives you the comfort that it will remain at or around the 3.1% mark? Are you going to increase loan yields? Is that what the expectation is, therefore?
Yeah, that is one part of it. That, of course, whatever you are going to lend, this additional cost has to be factored in. And this is getting factored in for the last more than 3 quarters, I will say. Customers also understand this. And we are watching good demand as far as credit requirement is concerned, whether it is retail or MSME or even corporate, at the increased rate of interest also. So that is one factor through which it will be factored in. And the second factor is that CASA, of course, we are very aggressive on CASA. Last full year, we onboarded 2.5 million new customers, new accounts as far as CASA is concerned. And in those accounts, as on date, the balance is around 9,000 crores plus. In Q1 also, we have onboarded around 10 lakh new customers for CASA customers only. And in those 10 lakh accounts, we are having around 1,900 crores of CASA as on date available in those accounts. So onboarding of customers is going to be the major part of the strategy for this financial year. Through CASA accretion and through little bit of increase in rate of interest as far as lending is concerned, I think we will be able to maintain NIM at around 3.10.
Okay, and if I can switch across to asset quality, what's in the pipeline? Where will NPA ratios go? You've had near zero slippage in corporate as per your presentation. Talk us through some of those factors that are playing out.
Yeah, slippage has been, I will say, one of the topmost priorities for us at IOB. And last 18 months, I will say 6 quarters, there has been nil slippage as far as corporate loans are concerned. Whatever slippages have happened, that is in RAM only, and RAM also, the numbers quarter on quarter, these numbers are going down. For this quarter, June Q1 quarter, our total slippage is 277 crores only, all consists of RAM, over a credit base of 2,29,000 crores. So the slippage ratio comes around 0.13%, which is so far the lowest. For last financial year also, our slippage ratio was 0.87, less than 1%. So slippages is one of the priority, and I am very happy to share the fact that the efficiency level as far as slippages control is concerned, that has reached at a level where we can safely say that going forward also slippages will be under control. There will not be any shock going forward.
Understood. And on the recovery side of things, if you can talk to us about what the expectations are, what has happened in Q1 in terms of recoveries, and what can we expect from full year FY25?
We did 582 crores of recovery in Q1, and for the full financial year, we are looking at 5,500 crores of recovery, and we are pretty confident that we'll be able to do it. In Q1 itself, we started very aggressively regarding sale of assets to ARCs. The process is still going on, and we hope that we'll be able to surpass this 5,500 crores.
Got it. So, one space where I've seen very strong loan growth coming for you is the agri space. Almost 10% or 9+% sequential growth. What's leading to this extremely strong growth in agri?
Two factors are there. One thing is that earlier the concept of agriculture used to move around KCC and tractor loans and other ancillary things. Of late, over last 3-4 years, many, I will say, corporate type of loans have also been made part of agriculture, including ethanol project, food processing, and many other things. So that is one part that even at corporate level, 30, 40, 50, 80 crores also, 100 crores also, it gets classified as agriculture. That is one part. And second part is that being in the southern part of the country, we are having almost 1/3 of the branches here in Tamil Nadu. And here, jewel loan, agriculture jewel loan is also a major factor, so which agriculture growth is happening.
Understood. So on the corporate side of things, do you expect the corporate capex cycle to pick up? Because around 20, you've shrunk your book in corporate. Now around 27% of your book is corporate. Do you expect that to start to inch up if the capex cycle were to come through? What's the strategy on the corporate side of things?
Exactly. See, we have already gone to the board and we have recalibrated our strategy. And we are looking forward to increase corporate book by around 35 to 40%. RAM, we are planning to reduce between 60 to 65%. Right now, we are 72%. So the 72 will come down to maybe around 60-61% RAM. And the corporate book we are going to increase. Of course, demand is there. And we have been able to lend, we are lending to corporates. And of course, as I said in the beginning, that is all matter of pricing and what value we are getting. Based on that, if it suits our requirement, if it matches with our priorities, we are absolutely going ahead.
Okay, and how quickly will this happen? Because it's a big shift. From 27, you virtually have to deploy 20 to 30,000 crore or, rejig 20 to 30,000 crore between RAM and corporate if this were to happen.
Yeah, it has to depend on deposit accretion also. Deposit growth, whatever we have planned, around 10 to 11%. Last year we also grew by 13%, so we do not see any challenge. So based on that, it may not happen instantly, but that is the intent, and I think by the end of the year, we will be closer to that mark.
Okay. And sir, with regard to ROA, you're at 0.7. What are the levers for ROA going forward? Where should it go?
Ideally, we are looking forward to grow beyond 1.
Okay. And how quickly?
Maybe that is what I'm trying to say. Maybe Q4 of this year. Maybe Q4 of this year it will happen.
Okay, understood. And sir, any divestment expectation from the government that you're aware of?
No, we have already taken approval of board and shareholders for raising 5,000 crores worth of capital. That is already under process.
Okay.
We have got these two major approvals, and by year end we are planning to do this 5,000 crores.
Okay, but no divestment expectation per se overall from whatever.
We have not
96.
had. We have not had.
Understood. Thank you so much, sir. It's been a pleasure speaking with you, Mr. Srivastava. It's good understanding the metrics of IOB. We'll of course interact with him again at the end of Q2 to try and understand how progress is. But with that, all the time we have on the show for you today. India Bulls Housing Finance is now Samman Capital Limited. Jio Samman Se, and keep watching NDTV Profit for all your business and stock market updates. Stay tuned.
Good morning. You're watching Ask Profit on NDTV Profit. I'm Smriti Chaudhary and with me is Alex Matthew. And on this show, we'll take all your stock-related queries, be it a short-term query or a long-term investment strategy. Do write to us on the WhatsApp number that's flashing on your screen or on any of the social media channels. And we'll take your queries from there. But before we jump into that, let's take a quick stock of the markets. The Nifty 50 trading in the red, down about 0.25% at this point, holding above 24,400 levels, a bit of a weaker day, a soft day rather, for the markets. Let's pull up the contributors of the Nifty 50 and you'll see that it's the banks that's pulling the index down today. It's HDFC Bank, ICICI, Axis, SBI, all in the red today. On the other hand, you have RIL, Tata Motors and NTPC in the green. On the broader end of the spectrum, you have the Nifty mid-cap doing better than what the benchmark is. It's up about 0.6% and small cap up over 1%, a percent higher. Let's talk about the sectors as well. It's the media sector that's doing extremely well in trade, up about 2% in trade. Oil and gas up 1.5%, energy up over 1%, and realty as well doing well in trade. On the other hand, you have something like consumption, FMCG, banks, autos, all in the red at this point. Let me also mark a couple of counters that are moving in trade. First is Bajaj Finance. It's also one of the losers on the Nifty 50, down over 2% in trade after their quarterly numbers. A rise in costs is what we've seen. It's a bit of a impact of that on the stock. There's HUL as well, down about 1%. Again, after its first quarter numbers. ICICI Securities has now come off its highs, a decent show of numbers there, but at the low point of the day at this point. There's Tata Consumer as well, down about 2.5% in trade after about a 3,000 odd crore rights issue. So there's a decline there as well. But of course, the focus for today is the FMCG space, and I'm joined by my colleague Mahima to give us a brokerage view on the budget announcement around the consumption that is likely to pick up in the country. Mahima, over to you.
Right, Smriti. So, as you rightly mentioned, the FMCG space is in focus post-budget announcements yesterday. However, the Nifty FMCG is taking a bit of profit booking today, but brokerages remain positive on the FMCG space. I'll start with Investec. They've said that, positive for urban, there are a lot of positives for urban consumption in the budget announcements, which is some of direct tax benefits, plus direct tax benefit transfers for the first-time employees. They've also said that ITC and Titan are the two companies that are the major beneficiaries because of no tax on the tobacco is an extreme positive for ITC, and the slashing of import duty on gold is a positive for Titan. What they've also said that is that higher spending on infrastructure has an indirect impact on FMCG, as there will be more disposable income in the hands of the rural population. So rural demand will see an uptick from here. What they've also said is that EN is now out of GST ambit, which aids cost for the spirit companies. So this will help them as well. Now, Nomura, however, says that it is a little cautious on consumption. However, JP Morgan again says that the tweak in income tax slab and increase in standard deduction will support the consumption and aid margins for FMCG companies. Jefferies has also mentioned that they are positive on ITC and Titan. CLS has said that ITC and Titan are discretionary plays and maybe key gainers. However, they've also said that the employment subsidy and the small tax cuts are supportive of affordable discretionary demand like QSR and consumer durables as well. And then JM Financial is saying that the financial support for setting up nucleus breeding centers for a lot of shrimp farming and exporting companies is also a benefit and positive for companies like Avanti Feeds, Epic Frozen Food, etc. And lastly, they're saying that higher revenue expenditure and rise in disposable income will aid growth for companies like Zomato, Gibran Food, Devyani International, and Godrej Consumer Products. So this is the overall view of what the brokerages are saying on the entire FMCG space post the budget announcement yesterday.
Thanks so much, Mahima, for getting us those details. Now, we've got Saurabh Jain, Equity Head Research at SMC Global Securities, and we've also got Vaishali Parekh, Vice President Technical Research at Prabhudas Liyadhar, joining in. Thank you so much to the both of you for taking the time. Saurabh, I'll come to you first on the announcements and lack of them and the resultant moves in the equity markets, and specifically on the FMCG pack. What do you make of them, and what would you buy at this juncture?
Hi, good morning, Alex. See, all the major points have been covered by a colleague. I feel that the FMCG pack will be good to it would be good to have in the portfolio. The companies that I like includes Bikaji Foods, Heritage Foods, and companies like Marico and Dabur. And apart from that, United Spirits, which have recently come up with the numbers, shown expansion in the margins and the good volume growth in the prestige and above segments. I think these are the companies which looks good from the investment perspective.
Okay, fair point. Vaishali, any opportunities that you're seeing in the FMCG space? Of course, we didn't really talk about it, but HUL results were yesterday as well.
Yes, see, FMCG counter on the whole has really shown a good run-up. So I guess in my understanding, right now is a time where it's just taking a breather. So we have been recommending Tata Consumer since a very long time, and it has come for a near-term target has been met with. So I would yet look at it. I mean, I would wait for a dip around 1200 levels to 1180 levels, because the further price projection, what we are looking at is around 1280 to 1320. So I guess FMCG counter should continue to do well, but for now, it's very likely that we can see some profit.
All right, let's start off with the queries now. Good morning to both the guests. The first one is on Canara Bank. This is from Narendran. Vaishali, coming to you on this one, they bought the counter price of 122, so slightly higher levels, but they say they can hold for a while. What's the short to medium term view on this?
Actually, we are looking at Bank Nifty on the whole, and 51,000 levels, if they break, then we may see some profit booking coming in. So likewise, even in the PSU banking stocks, we've been seeing SBI, Canara Bank, all are showing some signs of profit booking. So I would say that there could be a dip going towards around 100 levels also in Canara Bank. So it's for now, it shows signs of weakness.
All right, Jaspreet from Chandigarh is asking this next question. He's talking about sanguine movers for the perspective of the next 3 to 5 years. He's already bought into the counter and he's bought at levels of 1125. Slightly elevated levels. The stock is currently trading with gains of about 2.7%, but it is off his buy price. Saurabh, on the fundamentals, this has been looked at as a proxy to that infrastructure construction play. Would you suggest that this is something that you can hold on to for the next 3 to 5 years?
Certainly, yes. If you look, the capital goods and the infrastructure place looks very much promising. The government finances are all in control, and we are talking about the private capex coming in sooner. So in that sense, I think it makes sense to have a company like this in the portfolio. And apart from, Sanghvi Mover is a very old company. The operational metrics are also solid. And when we are talking about the growth coming in the future, I think the operational metrics will further improve from here onwards. And it makes sense to hold for another 3 to 5 years.
All right. Next counter is Godrej Agrovet. This is from Sriram, who's writing in from Thane. They bought the counter at a price of 485. It's currently trading above 850 levels, and it's up today about 2.8% at this point. Saurabh, on something like a Godrej Agrovet, we heard Miss Nirmala Sitharaman talk about some agricultural reforms as well. Is that what's going to play into Godrej Agrovet? And would you suggest maybe booking some profits, considering there's a good amount of profit here?
See, catalysts are in the favor of the FMCG pack, and the Godrej Agro is also moving in that fashion. I think surely the company is going to make benefits out of the measures taken in the budget, and above also we are seeing good amount of monsoon also this time in comparison to the last year. So I feel that the company will post a good set of numbers going forward. But yes, it is always good to book some partial profits. In that sense, if you want to book some partial profit, you can go ahead and shift your money in the companies like Bikaji or Heritage.
This is an open-ended question, Vaishali. This one's for you. We've got Akash Agarwal from Kolkata, and he's saying that he wants to start his investment journey with 50,000 rupees. That kind of narrows down the number of stocks that you can buy, at least those with a ticket price of above 50,000 not available. But what would you suggest that he can pick up in the short term for the next 2 to 3 months? I'm assuming that he wants to hold these for the long term.
So, well, I would go for stocks which are quite neutral right now. So, one of them is Coal India. I think right now what we are seeing, Pharma Pack is doing very well. So, Sun Pharma, Cipla, they still look good to me. ONGC, so basket of all these stocks should do well.
All right, the next counter is IRCTC. The question is from Vinod, who's writing in from Gujarat. They bought the counter at slightly elevated levels, above 1,000 rupees. It's currently trading at 973 rupees, given about 56% returns in the last 1 year. Vaishali, what's the short to medium term target on this one is the question.
IRCTC, actually, it has just been consolidating. I mean, and it's quite vulnerable to all the market whipsaws. So right now, I would say that, well, we are seeing it is showing some signs of profit booking. So on a broad base, I would say 940 acts as a support. This stock gathers strength only above 1050 level. So I would say just hold on. There's nothing really happening. Let it cross 1050 levels. Till then, I think it is just consolidating.
Right. GMR Infra is the next counter that we're talking about, and Dr. Sanjeev Dikshit is asking about this particular counter. He's bought at levels of 35 per share. He's holding as many as 5,000 shares. He's well in the money. He's making a decent profit on his investment. He's wondering whether to hold for the long term. Saurabh, based on the fundamentals, is this a counter that you would say that you should hold for the long term?
Certainly, yes, Alex. The company has improved its operational metrics a lot. The balance sheet has gone very much under change. All businesses are putting up a good show. It makes sense to hold for long term.
All right. The next counter is IndusInd Bank. The question is from Sujay, who's writing in from Kolkata. They want to know the 1 year outlook on this one. Saurabh, but IndusInd Bank hasn't done too well in the last year, actually, and right now it's the whole banking space that looks a little weaker. Would you suggest holding on to an IndusInd Bank or maybe switch to something else?
See, on the valuation side, if you look at it, it is probably trading at 1 time to book value. The operational metrics are also okay, but it's not the favorite among the private sector banks. I mean, if you want to go in the banking sector, in the private space, I prefer Axis Bank over IndusInd Bank.
All right, IndusInd Bank was the counter we just talked about. That was Sujay's question. And Gautam's got the next question. He's writing in from Mumbai, and he's got 2,500 shares of Wipro, which he bought at 502 levels. And he's asking whether he should hold or sell. It's not too far away from the current market price, and he's got a time frame of the next 12 to 18 months, which is not too far. But Vaishali, we've seen quite a bit of a crack over the last few trading sessions. He's bought it at pretty much where the market is right now for Wipro. Would you suggest that he holds on to this?
I would think so, because Wipro was showing a lot of promise prior to the results. Overall trend is still intact. It gets negated only below 490, 485, 490 levels. So I would say wait and watch, because overall what we are seeing is that IT sector is taking over, getting into momentum. So I would say if it's time is not a worry, then one should hold on, because in all likelihood this can retest at least 550, 570 levels.
All right, Vaishali, the next counter is WPIL. The question is from Dhansuklal. They say they bought the counter 20 years ago, and the counter is trading at an all-time high. Would you suggest booking profits into this one at this point, of course, or should you maybe wait a little bit more because you see more upside into this?
I'll just have a look.
Yeah.
So WPIL is 468. Yes, that's the price going on, right? I think there is still scope of further upside. There is no sign of fatigue. In fact, the indicators show that there has been a minor consolidation with 430 as support. And if all going well, if this stock continues to get into the trend, I think 500 would be the level to watch for, 500, 520. That would be an ideal level. So all the same, keep 430 as stop loss and look for a target of 520.
520 on WPIL. It's up and about in trade today, 3.5%. We have to slip into a very quick break. We'll take more of your questions on the other side, so do stay tuned. Welcome back. You're watching Ask Profit and we're taking all of your stock-related questions. By the way, in case you've got them, you can send them to us on the number that is flashing at the bottom of your screen. Yeah, you still see the whole number. All right. Let's talk about the first question then. We've got AB Capital. And this is a stock that Sumit Ghosh wants to know about. He's bought at levels of 222 and he's looking for a 3-month view. He's asking what the target and the stop loss should be. He's got 400 shares. Vaishali, on the charts, how does it look?
So right now we are seeing some profit booking happening, and 200 should be kept as a stop loss. If it goes below 200, the trend gets damaged. And if 6 months is the horizon, then this can go towards 260 to 280.
All right. The next counter is Premier Explosives. Saurabh, would you have a coverage on this counter?
Certainly not.
Okay. Vaishali, on Premier Explosive, the question is from Sastamani from Coimbatore. The outlook is 2.5 years. Now, considering the counter has run up significantly in the last 1 year, over 200%, do you see more upside from here on?
So this is one of the defense stocks, right?
Yes.
So I think long-term trend is still intact. Even if I'm seeing since the horizon time period is pretty much long, we may see some profit booking coming at this juncture, say around 550 levels and all. But still, I think as I'm seeing the upward trajectory, this can go towards 800, 850 levels. So that is how one can, partial profit booking should not be ruled out. And take a chance when it shows a little bit of a dip to add more and once again get on track for 800, 850.
All right. We've got a bunch of short-term questions. I am circling back to you on this one, Vaishali. We've got a number of stocks that I mentioned, but all frontline. Infosys, Cipla, and Sun Pharmaceuticals. Is this the right time to buy into any one of them or all of them? Rajesh is asking this question. He's got a short-term perspective.
So Infosys, I won't agree to it because though the trend is so strong, well, we've seen a good run up. But I'm looking at Cipla and Sun Pharma. They both look good to me. Sun Pharma, in fact, is showing a good trend. And well, for a near-term target, it is 1630. That's where the breakout level occurs. And 1635. So above 1635, we are ready for a target of 1650, 1660. So that is how Sun Pharma can be traded into. And Cipla, technically quite well placed. After a good consolidation, I think this stock should show some momentum and look for a target of 1530.
Ali, if you're in Mumbai, can you tell me when the sun will start shining?
Oh, sun has already started shining.
No, the reason I'm asking is that might actually be an easier question to answer than this next one, because Daniel is asking, will the Nifty 50 touch its all-time high this week?
Well, that's hard to tell. I won't be able to comment that.
Okay, so what are the key levels that you're watching for this week on the Nifty 50 then?
So I would say 24,200, a close below that brings weakness to Nifty. And about 24,650, we will say that we are back on track for higher targets. So in my opinion, right now, what I would say is that market is going through a sideways move. So right now we are seeing Bank Nifty is showing a lot of weakness, but the other stocks are holding well. So let's see, wait and watch scenario.
Right. The next counter is Ratnagiri Metals.
Ratnamani.
Sorry.
It's actually, it's
it's Ratnamani Metals. This is from Samir, who's writing in from Kolkata. The question is this the right time to buy the counter? Now, from a 1 year perspective, it's up about 40%. Vaishali, would you suggest, but seems to be in a bit of a consolidation. Vaishali, right time to buy this counter or should you wait?
I would say it is gradually going in an upward move, but well, one cannot rule out the market whipsaw. So if there is any meaning to it, I think 3100, 3200 acts as a very prominent support, which is also a 200-day moving average level, 3200. So I would say that accumulate with that in mind. And then longer term perspective, one can look for a target of 4,000 to 4,200.
All right. The next question is from Jeet, and he's asking about a couple of stocks that have done incredibly well. He's got BEL as well as HAL, Hindustan Aeronautics. He's got BEL at levels of 150. So this is a doubler for him. And he's got HAL at levels of 3,200, and he's done quite well here as well. Saurabh, based on the fundamentals, would you say that there is considerable upside from this point as well, or would you say that it makes sense to take money off the table?
I think it makes sense to take some money, partial money from the table, because while the growth prospects are very much bright, but at the same time valuations are too stretched. So in that sense, I think the valuations are actually capturing the forward future earning possibilities, future earnings. So in that sense, I think I would rather say book partial profits here.
Saurabh, would you say the same for an ABB? The question is from Shweta from Bangalore, who bought it at a price of 6,500 levels. It's above that price currently. But do you hold the same view for that one as well in terms of valuation?
Exactly. The growth prospects are very much promising, but the valuations have stretched in a very short span of time. It is always advisable to take some money off the table.
Okay, but at what level would you start accumulating on ABB specifically?
I think 15-17% kind of a correction cannot be ruled out. I think one should have a strategy to accumulate on correction in a staggered manner.
Okay. This next question is from Sri Kishore, and he's writing in from Motihari, Bihar, and he's asking about Keynes Technology, which he's bought at levels of 3,500. He's wondering what the perspective is for the next 3 years. Saurabh, any coverage on this?
See, the growth prospects are very good, but at the same time, valuations are stretched. So if you want to chip in these stocks, I think wait for corrections.
All right. The next counter is Irida. The question is from Radha Krishna. They say they bought the counter at a price of 300 rupees. It's currently trading below that price. Vaishali, coming to you on this one, what's the target and how do you see this play out in the short to medium term?
So I think this person has bought the stock at a very high price, and right now it is consolidating. But yesterday's low is of prime factor. If we see yesterday's low breaking in, then I think we can see further downslide going towards 200. But if these levels are held on, then I think at least his cost price will be retested. And if we see a further higher levels, then maybe 330, 350.
One last question we're slipping in. Borosil Renewables is the name of the counter. Lavish, a regular viewer from Indore, is asking about this. He's asking whether this is something to buy from the long term. There were some announcements with regard to solar in the budget, right? And Saurabh, anything that you would say about this? Would you buy? Would you hold on? He's bought at levels of 620.
See, imposition of duty on the material coming from overseas market is actually good for the company, and that is why we are seeing good amount of jump in the stock. I think it can certainly change the operational matrix for Borosil Renewables, because these companies, while doing capacity utilization at a very good pace, was finding very hard to make money, because the material coming from the overseas markets is actually cheaper than their cost of production. So imposition of duty is actually good for them, and I think fortunes will change for this company.
All right. With that, we're completely out of time on this edition of Ask Profit. Thank you so much, Saurabh and Vaishali, for joining us on the show today and for answering so many questions for us. Viewers, thanks a lot for watching. And thank you so much, Alex. It was a pleasure hosting this show with you. Unfortunately, this is my last show. With you, Ask Profit. And I hope you enjoyed watching. And don't go anywhere. There's lots more lined up for you on NDTV Profit.
Hello and welcome to NDTV Profit. I am Muralidhar Swaminathan. We on NDTV have been bringing expert voices since yesterday after the budget was presented. Today we are bringing in S. Naren of ICICI Pru AMC. He needs no special introduction. Naren is one of the leading voices in the mutual fund industry and the markets. Naren, welcome to the show. Thanks for joining us. Okay, my first question, what are the big takeaways from the budget for you?
See, basically, this is not the first budget presented by the NDA government or by the Honorable Finance Minister. We've seen a situation where over the years they have committed themselves to very good macroeconomics, very stable macroeconomics, and kept the country on a road where they are very, very clear that you have to handle fiscal and current account and everything in a very, very good way. So this is part of the trends. We all want some fireworks of some kind, but then they keep things very stable, the macro so stable that India has been one of the countries where the bond market, the currency market, everything is very, very stable at this point of time, thanks to the macro at this point of time. Then there is nothing like, something which has drastically changed from 2 days back to today. That's why even the markets haven't drastically changed from 2 days back to today.
Right. So very clearly, I think as the Prime Minister himself has been saying, the roadmap for 2047 has kind of been laid out. So from your reading, what we require is sustained growth. Do you think the specific areas of focus in the budget will help us achieve that sustained growth of 7% plus?
I think ignoring not just the budget, I think overall I would say that, if you look at the last 5 years, the kind of growth, for example, we have seen in services exports due to global competency centers set up in India has been just fantastic. And so we're seeing very, very sustained growth on the services side, particularly export. There was a time when, we had exports only of software. Today, we have got competency centers set up by so many multinationals in India, which are focused not just on IT, but on all kinds of services supporting their global outfits. So on that area, we have seen that. Now, the challenge actually is to create a situation whereby we are able to do that in manufacturing. And for that, budget is not the only document. We have to continuously keep improving the cost factors of cost of production on the manufacturing side, whether it is logistics, whether it is land, whether it is power, whether it is labor, everything, and there is a continuous challenge, because it is not that our competitor countries like Thailand or Vietnam or all those countries are not also trying to do the same thing. So even though, there is a China plus one strategy and the fantastic work done on PLI, which is not part of the budget document per se, I think there are continuous challenges because we have adequate competition in that area, unlike what we've seen on the services side. And the effort that needs to be continuously done to ensure that our power cost is reasonable or logistics cost is reasonable and land cost is reasonable, I think is a continuous onward journey, if you ask me.
Right. Typically we are a consumption-driven economy, and to a large extent, I find that the capex, of course, is 11.1 lakh crore, but the government has very clearly, the finance minister has said that they are not going to increase it further from what they did in the interim budget. So the ball is now in the court of the private sector. Do you think private sector is not doing enough to go for mega projects or scale that is required for us to sustain this kind of a growth?
I find, we at ICICI find this entire debate on private sector capex very not so logical. See, let's assume you're a cement company and you find that your capacity is utilized. Why would a cement company not put more capex? Suppose you're a two-wheeler or a four-wheeler company and your existing capacity is fully utilized. You'll put up more capex. So I don't think this debate on this entire private sector capex is justified at all, because every company will act on its own interest. Some of the problems that are there is to do with the fact that Indian corporate sector is in fine fettle and in great shape. So instead of borrowing from the banks or projects or from financial institutions to put up projects, they can just do it with the internal accruals that they have. That you don't see projects that are there. And second is, some of them are now not putting up grassroots projects where they need to actually set up from the bay, from buying from land, etc. And land is not costly in India. I'm sure land is much costlier in India than in most other countries in the world. So we have a situation where they're doing grassroots projects at this point of time. So this entire debate on private sector capex is quite illogical, because of the fact that many of them will do it if it makes sense to them, and why would they not do it? So as the sectors get fully utilized, they will do it, and we are seeing it across all the companies that we cover at ICICI Prudential, that most companies which are doing well and are using their capacity fully, they are doing capex and expanding. Are they doing it in new location? Are they doing it in existing location? Many of them are doing it in existing locations.
I think that's a very, very important insight that you have given to us. It's important to distinguish between capital requirement based on business, based on growth of individual companies, as opposed to the country's ambitions, if I could say. The next important issue, Naren, is about jobs. This has been a serious concern. There is growth. We have had tremendous sustainability in terms of growth, and we are the fastest growing. But in terms of jobs, there has been a huge problem. The budget this time around has specifically taken the route of incentivizing employers to generate jobs. What are your thoughts on this?
I think it's a fantastic step. I think, we have to encourage job creation by employer. Encouraging job creation by the state government or central government is not a way. I think the step that the government has done this time, both through the apprenticeship process and the other process that they give incentive for the companies to hire, particularly people who are paying less than a certain amount, is the right way forward. And I think the model is absolutely correct and logical at this point of time, and that is the right way. And I think we are very, very impressed by the way the government policy has been done in this budget in this area.
And that will lead to skill development, which is much required, I suppose.
Yes, absolutely. If you look at all the areas where we have actually gained in skill development, whether if you look at IT or whether you look at chemistry in drug area, all these areas, the skill development has happened because of these kind of things, and the step taken by the government this time to do it is, I think, a great step in the long term. Whether it will help in the next 3 to 6 months, it may not, but I think this will clearly help in the long term.
Okay, the other key area which is very critical for India to unleash its potential is the MSMEs. This budget is again focusing on MSMEs, especially their credit needs. Now that's a huge problem for MSMEs. Their cost of credit, even during normal interest rate regime, is very high. What are your thoughts on this? How do you think this will help the MSMEs unleash their potential?
I do not know. Maybe, I've worked for 35 years and we've seen in 90s people paying 16, 17, 18%. Today, even the MSMEs, many of them, which are financially in good shape, I think they pay a single digit, 9.5%, 10% maybe. So, I think it is important for MSMEs to practice good financial management and have good balance sheets. And if they do it, I think today there are so many providers that their borrowing costs are also more reasonable. I have seen unreasonable borrowing costs in 90s. I don't see that at this point of time. I think the challenges come to MSMEs if they don't have good balance sheets and they do not